Man.
Ah.
All right, we are live. Hello, everybody. We've got Tevis. We've got Riley. We've also got this guy, Tannor, who doesn't wake up this early, but he's up.
Nope. I'm up.
Here we go.
He's
Here we
up
go.
just to collect his prize.
Thank you. Thank you.
Beat you out by 1K, Amit. How do you feel about that?
Yeah, man. So we're gonna get into it. Tannor obviously said 479,000 members. I said 482, and Tannor was closer to it. Let me just share the result from Tevis's page. He had the quick breakdown. We've got a lot to go through. We'll have the call in 30 minutes. And then I'll pull up the pitch deck as well. So let me just pull not the pitch deck, the presentation. So let me pull this up and then let's get high level thoughts and then we'll get a little bit more deeper. So we have members, 480,000, 51% year-over-year growth. Product revenue, 695 million, 53% year-over-year growth. Galileo, 131 million, 31% year-over-year growth. Adjusted net revenue, that is 443 million, 1.54 billion for 70 million, 143 million annual. Deposits, 7.3 billion. That's what we thought. EPS, we got negative 5 cents per share versus negative 9 cents, beating that by 44%, which is pretty amazing. 2023 guidance, 430 to 440 adjusted net revenue, 40 to 45 adjusted EBITDA, and the stock is up 10% in the pre-market after being up about 40% in the past month. Tevis, quick start with you. Good results. What do you think of this?
I was just tweeting this out. Yeah, that EPS number was surprising to me. I think that came in definitely higher than I was expecting. The member count, I'm not surprised. I think Tanner's theory sort of makes sense with them tapering off the spend. Galileo, I think, was a surprising number just off the top because I think the consensus was that it was going to come in a bit weaker, but that kept a linear trend, adding 7 million accounts, every quarter. I think the last couple of quarters were 7 million accounts or so. But the guidance, I don't know. We can talk about the guidance. It seemed fairly weak to me, but fine. I mean, considering everything else that's going on. But the EPS number, man, I think Noto, and we can dive a little bit deeper into this because the call should be starting soon. But I think Noto said that on the current trend that they should be reaching profitability by Q4, which is earlier than the 2024 number that most people were expecting.
Okay. Tannor, your sort of high-level thoughts?
I mean, like I said, I'm going to have to read through a ton here. The only thing that I will say is that EBITDA is crazy. What a smash on the EBITDA that we saw on Q4. So that I'm really, really excited about. But like I said, I'm going to have to read through all of it. I can't make a decision what I like and what I don't until I have all the facts.
Okay. Riley?
Yeah, EBITDA was really cool. Down to negative, or the earnings per share negative 5 cents. That's way better than we were anticipating. So I'm excited. Can't wait to hear the call.
Okay, I believe the call starts at 8.
So, yeah, guys, I told you it is going to be prioritization on profitability 100%. Like, yeah. And I didn't expect that my number was going to be that close on members. I think that's just, sheer luck. But I didn't think it was getting anywhere near 500 or 530,000 for that matter. Fucking people dancing in excitement on over expectations. And then Chris Haggard talking from Disney World saying, you'll see, get out of town. Good work, Amit.
Yeah, I mean, overall, it's still pretty not bad with the with 480. So we have January, SoFi receives regular bank. That was big. February, they launch a breakup with bad banking campaign. SoFi Invest introduces margin. March, SoFi Money launches. SoFi acquires Technesis. April, SoFi credit card, 3% back. May, we have SoFi Relay for credit score monitoring. June, 4.5 hours to its trading day for the SoFi Invest product. August, Web3 SoFi stuff, smart energy ETFs. October, SoFi Plus. November, SoFi Invest begins options rolling up. In December, SoFi launches early access to Pay in 4. Do you think 2022 was a innovative year for them with all this stuff? that was done?
I mean, by default, the answer is yes, because bank charter just unlocked so much for them.
Good answer.
Fair.
Good answer. Yeah.
There we got member growth, 480,000. We have 5.2 members, 51% year over year. So in Q4 19, we had 976,000 members, and Q4 2022, just about 3 years later, we have 5.2 million. Grew 51% year over year. I mean, we all kind of thought this was going to happen, but did anyone feel like it was a little bit light, or do we feel like it was pretty appropriate for what happened?
It was pretty perfect. I mean, I know I was expecting 500K, but it was pretty damn close. 20,000 away.
Well,
you were 50,000 away.
Oh yeah,
at one point he said 600 too.
The last month I was being modest and I was saying 500K, and then on the live I decided to bury myself by saying 530. So yeah,
you said 530 plus.
Okay, 530 plus. I was optimistic.
Yeah, at minimum he's 50K away. But so here's the thing that I sort of don't, and I mean it's way too early for me to get up, but the thing that I kind of don't like about members is like this is now what the third quarter of a declining growth trend for the members. I'm assuming, or I'm hoping that that's artificially, motivated by them cutting the spend and just preparing to enter a rougher year. But that member growth has been sequentially declining in the rate of growth every quarter. I think now it's, it was like 10%, something like that, 10.5% on last month's or on last quarter's results. And then previous, it was like 11 point something, and then 12, and so on and so forth, to the point where Q4 2021 was a 17% increase quarter over quarter. So it's just been slowly just declining in terms of the rate of growth quarter over quarter. I don't know how much we want to read into that, but that's just the first thing I sort of noticed in this member account.
You guys aren't looking at it the right way. I said it was going to be 479, and then it became 480. This is more bullish. That's a beat, okay? So they are outperforming my expectations. So it'll be fun to see what the what the per person acquisition costs are. I'll have to throw that all into my spreadsheet and everything, so to see what the trends are. But I'm just waiting for this call, and then I can, I can probably do that actually in between, and then see what numbers I can grab before we get the 10Q, which I'm sure is not going to come for another week.
Products is again, correct me if I'm wrong, this is like anything they sell to a member, like student loans or anything like that, right?
Or relay.
And Sofi Invest though is not included in that.
It is.
Okay.
This is total. So Amit, so this is 53%, and yeah, like that's cool. But just scroll a couple of slides down for me at their flywheel, because that was the thing that blew me away. Look at this, 4.9x financial services products to lending products. Like that flywheel is just continuing to accelerate. That's this was probably the best slide that I saw with just a quick skim through. I think this is fantastic because that's their whole, bull thesis on their flywheel, right?
Yeah, I mean, again, it's not like when they add 480,000 members, it's not just these are users that are dead accounts. I mean, ultimately they have to be using the product, and if they're able to sell them this stuff, they're
quality members, right? And like the thesis is that products is always going to grow faster than members will on a percentage basis, because that flywheel is just going to keep increasing. Like if you subscribe to that notion, then products will grow faster.
Our good friend Chris Patel thought they might barely hit 300,000 members.
Well, you know what? To give Chris less credit than that, he said the worst answer. He said between 450 and 300,000. That's the most cop-out answer I've ever seen. So if you're gonna give a prediction, give a prediction. If not, don't worry about it. Like, just his tweet got way too many likes for being so just a guess.
He added the 300 there just to make people get scared. For those that are here, we are starting the earnings call in about 20 minutes. So we're just analyzing the call or analyzing some results right now. Then we'll hear from the man himself, Noto, in a little bit. And we'll go from there. Quarterly adjusted net revenue, $443 million in one quarter. And Tevis, you said they're guiding for 430 for the next quarter, right?
Yeah, if you scroll a couple of slides down, you can see 2023. You'll see 2022 and how they performed to that, and then you'll see 2023 guidance. It's pretty much in a range. So this is how they performed, and then the next slide over is 2023. It's pretty much in range with what they reported this quarter. So yeah, 2023 non-GAAP for Q1. This is between 430 and 440 for adjusted net revenue and $40 to $45 for adjusted EBITDA. And the interesting point here, Amit, is if you just scroll a couple of slides up. One more. Right here. So this annual adjusted EBITDA at 143 million, this is the number that is the number to watch for profitability. This is the number that I think, along with the flywheel, this was the thing that impressed me the most, is that, -5 cents EPS versus that -9 cents expected by analysts. I mean, even if you expect Sofi to beat, look at their last quarters, it's like 1 cent higher or maybe 2 cents higher, but it's not, 4 cents higher. And I think that was a number that caught a lot of people off guard because it signals that the company is closer to profitability than most people were expecting. So Q4 2023 is a number that Noto quoted. But of course, if you want a more bullish take than that versus a more bearish take than that, I think end of 2023 was the number that, just naturally being a little bit more bullish, that I was expecting for Sofi. So really excited that it's now reflecting in the numbers, and hopefully that trend increases in Q1 of 2023 as well, so that they reach profitability closer this year.
Right.
Yeah, and I think this is like the most important slide in a way, because what it's really showing here is that we're looking at member growth and product growth and going, growth is slowing. It's not slowing at all. It's just not a priority, right? We need to make sure that we can survive whatever is coming forward, and profitability is by far what is going to keep us in the game. So we are seeing such a beat on earnings, and that is going to be the focus of this earnings call, is just saying, look, whenever we actually put our focus, and this is Noto's specialty, right? We can twist and turn these knobs to make the outcome of this quarter exactly what we wanted every single quarter. They guided for 400,000 members and they got 480,000. Is that a miss? Not at all. Maybe in people's expectations, but they only wanted 400,000. So you know what? They surpassed that. They did everything they needed to do. They got their 20% extra. Okay, now let's just absolutely crank this profitability wheel and look at the EBITDA. I don't wake up this early. I'm an 8:30 guy, but yeah, the EBITDA is
do you drink coffee in the morning?
I haven't had a coffee. I do drink coffee, but I haven't had a coffee. So I kind of just rolled out of bed, showered, and then set up all my lights, and I'm here.
Yeah, go get one, man. It's gonna be a long call.
I'm good.
Okay, I have a question for some of the noobs here in the finance world. So EPS is -5 cents per share versus -9 cents per share. What exactly does that mean, and why is that so good?
Are you asking this because you don't know, or
exactly?
Well, so I get earnings per share theoretically, but like for people that really need to, I would like a better explanation for this.
Yeah, so just take their earnings as a net income or net loss. And then divided amongst the amount of outstanding shares. So this is the problem with every newbie in the stock market, and whoever's not muting's got to mute up. But pretty much the idea is that if someone looks at a stock and sees that Apple stock, I go up, I think. If someone sees that Apple stock is, I don't even know what they're at right now. But versus Berkshire Hathaway, you could see that, Berkshire Hathaway stock at like, $400,000 or whatever it is today, is a much bigger company, but really it's not. It's just how many times that the pie has been sliced into multiple slices. And so some people like to see earnings per share because then it kind of takes out the, the dilution in a way. Whatever amount of shares I have, that's the amount of earnings that I got per share. So instead of getting -9 cents per share on our $5, $6 shares, we got -5 cents. But that's only on GAAP earnings. Okay. So you also have to kind of understand that what Chris Hager's been saying, that a lot of this is going into performance-based stock units, and that, the only way that actually turns out to be a thing is if the stock is $25 or $45, and not halfway through, like not if it's $24 by 2026, then he still doesn't get anything, and then we've actually made a lot of money. So there's a difference between, net incomes and profitability in a quarter and a burn rate. So SoFi is not burning money. They're actually accumulating more money every quarter. It's just some of it goes to non-cash charges. So the business is getting stronger and stronger.
And so basically, instead of losing 9 cents per share on a GAAP basis, generally accepted accounting principles, they're losing 5 cents per share, which means you could theoretically imagine if they start losing 3 cents per share, then 2 cents per share, then maybe by the end of Q3, if all things go well, they are making a couple cents per share, which means they are profitable.
Yeah, as long as the share numbers,
yeah.
as long as the share numbers stay constant and they don't massively dilute their shares, then yes.
Right. And so, And so, and Tannor, can you explain a little bit why in this year in particular, profitability is all that matters versus growth, like in 2020 or 2021?
It's just what the market wants to see, because there's restrictions and restraints, right? People are worried that the lending market might come to a complete stop, that people are going to lose their jobs, that people are going to, that it's going to be a bad economic year, that we're going into a recession. So there's going to be no VC funding. There's going to be very little, outside capital. And so the only way that a company can survive if they can't go knocking on doors at Wall Street and asking for money is they have to be self-funding. And the only way to self-fund is profitability. So that's really why it's becoming the big trend right now. But if things start to look up and things start to get better, growth will be back in the picture. And that's why you're seeing stocks like SoFi, even like Coinbase and these sorts of really risky stocks starting to improve on their share price, because risk might be coming back. There is some people who are ready to put their money into riskier stocks. That's why you see Tesla going up like, 60% since their lows.
Yeah. And like it just anecdotally as well, Amit, if you just see us entering a bad year, what stocks do you want to be holding? You want to be holding stocks that are profitable or stocks that are not profitable, right? And so that's why profitability is like so much more important, because people just want an extra layer of stability and safety, knowing that they're holding something that potentially won't need any more additional funding in a rough time when funding is not easy to come by.
Yep, I would agree. So on the high side, they think they'll bring $2 billion this year. On the low side, they think they'll bring 1.925 billion. 2 billion would be 30% year-over-year growth. 1.9 would be 25% year-over-year growth, which is lower from 53, 63, and 38. But again, as we talked about for the past 20 minutes, if we can become profitable, that would probably matter a lot more.
And you know what's so funny about guidance for SoFi is that they've never been good at it at all. Like it's actually a miss for SoFi to say that they were going to guide for 9 and then they get -5. Like that is actually a bad sign from management, saying that they don't know how well their company is going to perform. It's okay for a company to be a little conservative, but to be extremely conservative, like large beats, is actually not a good consistency, because then it means that whenever they guide for 2023 and they go, okay, this is our full year guidance, it's like, okay, can we even trust that at all? Or are they going to beat it by 40, 50%?
Well, don't you want them to sandbag it at the don't you want the market to?
You do and you don't. But
it's a huge sandbag at this point.
Yeah, if we are sandbagging it, then we're going to have to wait a year to see those results. If they were to have been 100% on the ball, then we would see the results in the stock price today, right? So if they are good at predicting earnings and they meet every single time, then people are going to be like, wow, this CFO is unbelievable. He nails the ball every single time, and that we can actually take his word whenever he says 2023 is going to be an amazing year. And then people will run into the stock market today for future earnings going down the line. If you're being conservative and sandbagging all the time, that means we have to wait to see those earnings.
Okay. Galileo reached 131 million accounts. Was this impressive to anybody? I know they'll talk more about it on the call, or was this kind of just like decent for them to be able to do?
It is what it is. It's what we expected, I think.
So interestingly, Tanner, on that point, as you're saying that, one of my thoughts went to, could them cutting expenses have been the reason for like their EPS being higher? Because like, if that's the case, then that's higher. But I'm looking at it. I'm looking at the report right now. Their expenses actually increased in pretty much every single category.
On a quarter-over-quarter basis or a year-over-year basis?
Well, both. Yeah. So we have to dig into the numbers more so than to actually gain some tangible insight as
let's
to
look at what Stock Market Nerd, his little summary.
Here, I can actually send you the report a minute, so you can actually see not the presentation. I have it on the screen at least.
So beat revenue by 4.2, beat EBITDA by 6.7, beat GAAP by around 44%. Forward guide missed by 4.2, revenues missed by 2.8 for the guidance. EBITDA beat by 6.1%. Moratorium extension hit results. It prevented. So they said nothing about student loans. Obviously, in the presentation, we'll hear on the call. SBC is 20% of 2022 sales versus 24% in 2021. So SBC went down. It's expected to be below 10% in 2024. That would. Okay, so we don't know 2023 what it would be, but that would be a decent 50% decline in the next 2 years. Total deposits grew 46% quarter over quarter. That was a nice one. Tech platform CM contraction via Technisys and aggressive investments as expected. Incremental GAAP net income margin for 2022 is 28%. Is there any reason for the market to kill the stock at open like they did last time when we were up 18% in pre and then they shot us down? Do you think that could happen again?
Definitely. I think the big beat in EPS will be a good sign. I think Wall Street does not care about member growth right now. I guarantee that. They want to see earnings per share, and that's a much better beat. So it might be very good for us. But then again, it's all about guidance right now into the forward year. So, but I just want to point out really quickly on this snapshot because it's just so easy to see. Whenever you actually look at this quarter's results, you can see that EBITDA beat by 67% on a single quarter. That's incredible. And then forward guide also beat by EBITDA by 6%. So what happens next year if each individual quarter we start beating by 40 to 60% or 67% on EBITDA on an increased guidance? You know what I mean? It's just the compounding effects here are great. It's just whether we can keep beating on the actual quarters that we're expecting, because obviously SoFi likes to be very conservative in their guidance, but I think it's just kind of like a little bit of a piss off. I can't say anything else.
Okay, cool. All right, we've got 7 minutes for the call. 346 people here. Thank you for being here. If you don't know who we are the SoFi Weekly Boys. Everyone's links are in the description. Please make sure to follow and subscribe to everyone who is here. If for any reason, just to keep updated with SoFi, which is one of the things all of us talk about religiously because we are invested in the company. And it's really cool in this day and age to do like this retail crowdsourcing of information to actually create content around your stocks, because they didn't have this in the 1990s. And, it's like if the stock actually appreciates the way we think it will, we have a couple years worth of content explaining why we thought it would, which is super cool. So it's awesome that you guys are part of the community, that you're joining us here. Nick McDermott, morning boys, great to be a SoFi shareholder. Thank you for being here. And we'll get started in about 6 minutes.
Is there any way that we can put the call and the stock price up?
Yeah, I don't know. I mean, StreamYard is really limited, and like they need to add. They have too many users to.
This is why you need OBS.
No, but OBS crashes like every other day. Like that's the problem.
I mean, can't you just share one of your screens and have like the right side filled up with the cute?
Yeah, you could do that.
Audio.
Let me see. So this is the call.
Does anybody have any questions just before we get on the call? Shoot them in the chat.
If I do this, what do you guys see? Yeah, no.
Yo.
I just,
Where is that quarter app when you need it?
It's not for desktop. I mean, it is for desktop, but that's for the pro users. That's how they make their money.
Oh.
yeah, no, guys, it won't let me share multiple things.
Man, you don't need the full screen, man. It's just audio, isn't it?
Yeah.
Okay, so you just want to stare at the price the whole time then?
Yeah, if we had like a technical
No,
chart, that'd be kind of
literally share your entire screen and then just split 2 windows on your screen that you're sharing.
That's what I'm doing. So this is not the full screen right now. This is hold on. Let me see if I can.
Yeah, you're showing one individual application. You can share your window.
Okay, so hold on. Let's do this. Let's do this.
I've been holding out on recording videos about SoFi because I didn't want to do it with old Q3 numbers, but there's going to be a wealth of videos coming now, guys. Hopefully everyone's excited. At my channel only, so.
I'll just react to your videos and then barely do a reaction. You're like, guys, we gotta react to this guy on SoFi, and they'll just stare at you the whole time. Like, so I hope you guys enjoyed our analysis. It seems like
Yeah. So YouTube sent me a copyright strike flag for that one video that you posted of mine, and they're like, "We found this. Do you want to shut this down?"
Bro, I wish you would have done it. I would have fucking
no, because you can have
like you fucking bitch. That would been so funny. Oh my gosh.
They can have like some permanent problems. You can't get like 3 of those, I think.
Yeah, I'm excited about Riley's video. I mean, so I don't know, maybe I'm not supposed to say this, but just for everybody, the 340 people in the chat, he showed us an early cut, and it's just like, it's very nice editing. I was very jealous, but I don't know when it's going to
He's a good editor.
Yeah, he's great.
Thank you.
Yeah, guys, it's not letting me show 2 things at once. It
right,
only
this
lets me show 1 tab.
Amit, how? Okay, hold on.
If you I have SoFi here, I have Robinhood here with the prices, and it's not showing because you can't share another screen. If I have to press stop screen like that,
you can't share your entire window.
Now share an entire window.
Yeah.
There you go.
A window. Oh, hold on. If I do this. Okay,
Yeah.
so
There you go.
Drag it
now
to
we go here.
There you go.
Yeah.
Oh no.
Oh, holy!
And then
crap.
drag the other one.
Okay, give me 1 sec. Okay. Now we're gonna do this guy. Do you see Robinhood?
Actually, it shouldn't be window. It should be screen, I think. Or here, let me try sharing my screen.
No, yeah, you're right. It should be screen.
Yeah,
See?
share
Yeah.
entire screen. It literally says entire screen.
Okay, hold on. Share. Oh shit. Oh,
It's like literally an option.
Yeah, it's the first option, by the way,
There
guys.
you
Just
go.
so then it's possible.
Dude, SoFi.
is that it? It's working.
Yeah, you got it.
40 minutes ago, SoFi was at $6.73.
Yeah, you must be
That's
new here.
insane.
Yeah, seriously. I'm surprised it didn't jump up to $13, then back down to $5.
Tannor, now's your chance to get a coffee 2 minutes before the call if you need one.
That's what I'm gonna do. I'll be right back.
I might also do that. All right.
Go for it, boys.
We're going to Tim Hortons real quick.
Dude, it's snowing
Relax.
here. It's full on snowing outside. It sucks.
Can you guys hear this audio?
Cut Amit some slack. He's building an audio platform, not a video platform.
Wait, can you hear this audio, Tevis?
Yeah, I can hear you. Wait, no, I can't hear that audio.
Okay, hold on. Did I not press fucking share audio tab? Hold on.
This is if he didn't have 60,000 followers, you think we'd let him host these? There's no fucking chance in hell.
Okay, now you should be able to hear it.
Yeah, we hear it. Does everybody hear that? Just a thumbs up in the chat. Amit, can you play it again?
Yeah.
They should be able to. Yes, thumbs up. All right, turn it off. We're good. Yeah, I can't believe there's 370 people watching. Holy shit.
They're only here because of your face.
How do all these people wake up this early, man? This is Jeez.
I don't get how you guys don't. Do you guys not wake up early in the morning?
I work in tech, so I'm pretty fucking spoiled when it comes to that.
Like, so when do you wake up? Like 10?
No. Sometimes I'll wake up at like 7:30 to go to the gym in the morning, but usually it's like 8:30, 9.
And what do you do first thing you wake up?
Brush my teeth, have a shower, get coffee. Just the normal human things to do.
I do 700 push-ups as soon as I wake up. So, wow, we had a big little movement on the stock right there.
Yeah, dude, I've seen your body. You don't do 700 push-ups.
No, you haven't realized my push-ups just aren't working yet. But do the push-ups. They are done. They are indeed done. Make sure you guys like the stream, please. We got 65 likes, 300 people here. Please make sure to like it.
Well, Tannor and Riley aren't here. I'll take the chance to say my link's in the description.
Yeah, follow Tevis, Fundamentals of Investing. He's a good YouTuber. We're going to do a podcast on Pinterest soon and discuss the bull case on that.
Yeah, when they report earnings, we'll do one on Pinterest. Dude, okay, so we did a podcast on Tesla together, and we just broke down everything. And so normally I'll clip the Sofi videos and post them onto my channel as like a highlights video every Sunday. And those videos get like, within a certain range of like 1,000, 1,200, whatever, like in a day. And then we did this Tesla one. I clipped that into a highlights video and it got like 30 views. It's like, fuck.
Even Tesla's keyword couldn't carry that video.
Yeah, seriously.
You guys talking behind my back?
Yeah.
Yeah, we basically said you're a Sofi bear disguised as a bull.
Yeah. The most accurate bear alive, okay?
Yeah.
I'm going to hold that above you guys forever.
Chris Patel 99 is actually your alt account.
Oh my gosh.
I let this cat into the room, but I think he's going to... He already unplugged the light already, so... maybe I'll get him out of here.
Why did James say "damn it" Amit? James, what's wrong? Watching from Brazil, so it's 10 a.m. here. Cool. I'm listening to the UK.
Should turn this music down.
Yeah, seriously.
You guys don't enjoy the elevator music?
Good morning, and thank you for attending today's Sofi fourth quarter and full year 2022 earnings conference call. All lines will be placed on mute during the presentation portion of the call, with an opportunity for question and answer at the end. At this time, I would now like to turn the conference over to our host, Maura Sia, Sofi's Investor Relations.
They seem close.
Thank you and good morning. Welcome to SoFi's fourth quarter and full year 2022 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantages and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our upcoming Form 10-K as filed with the Securities and Exchange Commission. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you, Maura, and good morning, everyone. 2022 was a remarkable year for SoFi. We accomplished more than any of us could have hoped for. Our resilient team drove great execution of our strategy that is proven to provide the benefits of business diversification and durability to deliver exceptional growth and improving profitability. Our adjusted net revenue grew 52% in 2022 to over $1.5 billion, and we delivered nearly 5 times the adjusted EBITDA we did in 2021. We obtained a national bank license, which could not have come at a better time, allowing us to be incredibly flexible in a rapidly changing environment. We're offering a compelling SoFi Money product that is driving high-quality direct deposit customers, spending, and deposit balances. The deposits bolster and diversify our sources of funding, enabling us to offer our best rates on loans while generating impressive returns and improving net interest income revenue. In fact, 2022 marks the first time our lending net interest income revenue of $530 million by itself exceeded our total directly attributable lending cost of $443 million. We grew our deposits 7 times to $7.3 billion from $1 billion over the course of the year, really powering that cycle. We grew our member base by 1.8 million to 5.2 million members, nearly 9 times our size in 2018. We acquired Technisys, adding a critical capability as we build our end-to-end technology stack and bringing us one step closer to being the AWS of fintech. We navigated unparalleled market volatility, macro headwinds, high inflation, and increasing interest rates, and 2 unexpected extensions of the student loan moratorium by reacting nimbly and leveraging the diversification of our business to hit record revenue in each quarter of the year. The fourth quarter was an incredible end to an exceptional year. We delivered another quarter of record adjusted net revenue and adjusted EBITDA and strong overall operating results. A few key achievements from the quarter include our 7th consecutive quarter of record adjusted net revenue of $443 million, up 58% year-over-year, which accelerated from 51% year-over-year growth in the third quarter and reflects record revenue in all 3 business segments. Record adjusted EBITDA of $70 million was up 58% quarter-over-quarter. That is nearly equal to the total adjusted EBITDA in the first 3 quarters of the year combined. In Q4, we achieved a couple of important financial inflection points. Adjusted EBITDA of $70 million is now largely equal to share-based compensation expense of $71 million, a critical step toward GAAP net income profitability. Additionally, net interest income revenue, or NIM revenue, of $183 million exceeded lending non-interest net revenue of $144 million for the first time. And importantly, our NIM revenue is meaningfully greater than our directly attributable lending expense of $106 million. In Q4, we had an incremental GAAP net income margin of 42%, resulting in a loss of just $40 million, roughly half of the third quarter 2022 loss. Said another way, of the $171 million of incremental GAAP revenue year-over-year, $71 million, or 42%, dropped to the GAAP net income line. Given these accomplishments, in our 2023 plan, we expect to achieve quarterly positive GAAP net income in Q4 2023. Our strategy is continuing to play out with SoFi Money, which allowed us to surpass $7.3 billion in deposits, up 46% quarter-over-quarter, and savings of 190 basis points on cost of funds versus using other sources of debt to fund loans. Another quarter of positive GAAP net income for the SoFi Bank at over $30 million and at an 11% margin. Finally, we grew our tangible book value for the overall company for the 2nd consecutive quarter. Q4 also saw our 2nd highest quarter ever of member ads and our 3rd highest quarter of product ads, with strong momentum continuing into Q1. The 487,000 new members in Q4 2022 brings total members to 5.2 million, up 51% year-over-year. We also added nearly 700,000 new products in Q4, ending with nearly 7.9 million total products, up 53% year-over-year. Of these new ads, financial services products grew by 60% year-over-year to 6.6 million, while lending products were up 24% to over 1.3 million. The strength of our results once again underscores how our full suite of differentiated products and services provides a uniquely diversified business that has been not only able to endure, but to thrive through market cycles. Now I'd like to touch on segment level results with a particular focus on the benefits of our diversified business drivers, as well as the structural advantage of our bank charter. In lending, we generated a record of $315 million of adjusted net revenue, up 51% versus the prior year period. Our personal loan performance more than offset the continued lack of demand in student loan refinancing and the less robust performance of home loans. Student loan refi continues to be negatively impacted as federal borrowers again await clarity on the end of the moratorium of federal student loan payments. Home loans faces macro headwinds from high rates while we continue the process of transitioning to new fulfillment partners. The personal loans business maintained its strength in Q4. We originated nearly $2.5 billion, up 50% from $1.6 billion in Q4 2021. This product continues to deliver even as we've raised our coupons to our borrowers as a result of rate increases and maintained our stringent underwriting criteria. While these origination levels themselves are impressive, the strength of our balance sheet and diversification of our funding sources provide new options to fund lending growth while driving efficiency with cost savings. These advantages are a direct result of SoFi Bank. Having more flexibility with our balance sheet allows us to capture more NIM and optimize returns, a critical advantage in light of the macro uncertainty. Additionally, by using our deposits as a funding source, we benefit from a lower cost of funding for loans. In Q4, the difference in our deposit cost of funds and warehouse cost of funds was approximately 190 basis points, whereas 125 basis points in Q3 and just 100 basis points in Q2, a powerful benefit in a rising rate environment. Lastly, the bank contributes to strong growth in SoFi Money members, high quality deposits, and improved levels of spending and engagement. This has led to higher average balances, even as average spend has increased. Of the $7.3 billion in deposits at quarter end, 88% were from direct deposit members. Roughly 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30 versus 20% in Q4 21. And this has had a significant positive impact on spending.
What was that number?
Q4 annualized spend was 3.4 times 2021 total spend, and Q4 spend per average funded account was up 25% quarter over quarter. SoFi Money members have increased nearly 53% year over year to 2.2 million in total. Given the quality of these members with 745 median FICO score, we see ample opportunity for cross-buy. This is a great segue into financial services more broadly, where net revenue nearly tripled year over year to $64 million and grew 32% from $49 million sequentially in Q3. Moreover, financial services annualized revenue is now approximately $260 million. Contribution loss of $44 million improved $9 million versus the third quarter, even as we invested $13 million more in marketing in the fourth quarter. We saw this as a worthwhile opportunity to attract more direct deposit members. Even with this spend, variable profit, including all marketing costs, improved quarter over quarter and was nearly break even. We still anticipate the financial services segment will be contribution profit positive in 2023 as we continue to scale and monetize the business. We finished Q4 with 6.6 million financial services products, up 60% year over year, and 4.9 times total lending products of 1.3 million. The increased scale in financial services helps drive cross-buy and marketing efficiencies over time. The scale of financial services not only drives cross-buy and marketing efficiencies, it also is proving to be a large revenue contributor as we continue to drive monetization of these businesses. In fact, annualized revenue per product is up nearly 2x from $21 in Q4 of last year to $40 in this quarter. This is due to the increasing attractiveness of these products, growing brand awareness, and network effects. As we've committed, we continue to iterate and invest aggressively in our product suite. and that investment continues to pay dividends as members embrace our launches. Since our last earnings call, we introduced an increase in our checking and savings APY of up to 3.75% as of January 4th. We launched SoFi Plus, a premium member service that bundles together our wide variety of member benefits and provides incremental value and rewards. SoFi Plus is unlocked through enrolling in direct deposit. We will continue to add more value and benefits to this premium member service to not only highlight the breadth of our products and services, but to also increase the total value of having your direct deposit with SoFi. We expanded insurance coverage for our members to include cyber insurance. Our Invest team launched options trading, making good on our promise to our members to deliver this much anticipated service. And we introduced a new way to spend with SoFi with Pay in 4, their first product built on the combined Galileo and Texas's platform. This leads me to our technology platform segment, which remains a critical element of SoFi's strategy. In the fourth quarter, full segment revenue of $86 million grew 61% year over year, with a 20% margin at the segment level, or 24% if you exclude Technisys. The SoFi technology platform strategy includes growth in new verticals, new products, and new geographies. In Q4, Galileo signed 11 new clients and made big strides in the strategy, with 36% of new deals in B2B and 27% of new deals outside the United States. Importantly, of these 11 new deals, 9 have existing customer bases, reflecting the continued demand for our innovative services from more mature organizations. Technisys is also delivering strong growth in number of new clients, signing an additional 16 new clients in Q4, including its first digital deal in Mexico. I'll finish here by saying that we've been in an all-out sprint over the last 5 years to build out our digital product suite to meet our members' needs for every major financial decision in their lives and all the days in between. The benefits of our strategy, resulting in a uniquely diversified business, combined with a national bank license, not only positions SoFi to be the winner that takes most in the secular transition of the financial services to digital, but also to provide greater durability through a market cycle. I'm excited about where we are today, and even more excited about where we can go from here. With that, let me turn it over to Chris for a review of the financials for the quarter.
Thanks, Anthony, and good morning, everyone. We finished off a remarkable year while navigating a rapidly evolving macro backdrop, even as our previously largest and most profitable business operated at 25% of Q4 2019 pre-COVID volumes. This proves once again that our diversified and differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk you through some key financial highlights and then share some color on our outlook. Unless otherwise stated, I'll be referring to adjusted results for the fourth quarter and full year of 2022 versus fourth quarter and full year of 2021. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-K filing, which will be made available in the coming weeks. For the quarter, top-line growth accelerated, and we delivered record-adjusted net revenue of $443 million, up 58% year over year, and 6% sequentially from the third quarter's record of $419 million, and above the high end of the guidance provided during our last earnings call. Adjusted EBITDA was $70 million at a 16% margin, also above the high end of our most recent guidance. We saw 14 points of year-over-year and 5 points of sequential margin improvement, demonstrating the strong operating leverage of the business as it scales. Year-over-year margin improvement has been driven by significant operating leverage across our sales and marketing, G&A, and ops functional expense lines. Overall, this resulted in a 40% incremental adjusted EBITDA margin year-over-year. Our GAAP net losses were $40 million this quarter, a $71 million improvement year-over-year, and $34 million improvement sequentially. Incremental GAAP net income margin was 42% year-over-year, a notable step in our path to GAAP profitability. In addition to our adjusted EBITDA margin expansion, we saw meaningful leverage against stock-based compensation as a percentage of revenue at 16% in Q4 2022, down from 27.5% in the same prior year period, putting us well on our path to longer-term goal of single-digit stock-based compensation margins as previously communicated. For the full year, we delivered $1.54 billion of adjusted net revenue, up 53% year over year from $1.01 billion in 2021. As a reminder, we revised our annual guidance in April of 2022 following the extension of the moratorium on federal student loan payments. Our updated guidance for the year included $1.47 billion in adjusted net revenue and $100 million in adjusted EBITDA. This guidance contemplated an ultimate extension in the moratorium until year-end, which implied a Q4 ramp in student loan refinancing activity ahead of the anticipated resumption of federal payments. From an adjusted EBITDA perspective, we delivered $143 million in profit, nearly 5 times that of 2021, and $63 million above the guidance we presented following the moratorium extension I just discussed. 2022 delivered a 9% adjusted EBITDA margin, 630 basis points of improvement from 2021. Even with the recent subsequent extension of the moratorium through June of 2023, which impeded the expected Q4 2022 ramp in student loan refi demand, we still exceeded that revenue guidance by $80 million and adjusted EBITDA by $43 million. We achieved these results by implementing new strategies and through nimble asset allocation, which speaks to our ability to leverage the diversity of our revenue streams. Now onto the segment level performance, where we saw strong growth across all 3 segments. In lending, fourth quarter adjusted net revenue grew 51% year over year to $315 million. Results were driven by 138% year over year growth in our net interest income, while non-interest income was relatively flat. Growth in net interest income was driven by a 109% year over year increase in average interest earning assets and a 317 basis point year over year increase in average yields, slightly offset by a 162 basis point increase in the cost of interest-bearing liabilities. This resulted in average net interest margin of 5.94% for the quarter, up 141 basis points year over year. Non-interest income was relatively flat year over year as increased personal loan originations at higher weighted average coupons were largely offset by lower student loan and home loan originations. Personal loan originations grew 50% year over year to $2.5 billion, while student loan originations were down 73% and home loan originations were down 84% year over year as a result of macro headwinds and a continued transition of home loan fulfillment partners. Overall, we achieved strong top-line growth while maintaining our stringent credit standards and disciplined focus on quality. Our personal loan borrowers' weighted average income is $165,000 with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $170,000 with a weighted average FICO of 773. This focus on quality has led to continued strong credit performance. In fact, our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 34 basis points in Q4 22, while our annualized personal loan charge-off rate was 2.47%. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points in Q4 2022, while our annualized student loan charge-off rate was 0.37%. As we have expressed in the past, it is reasonable to expect credit metrics to revert over time to more normalized pre-pandemic levels, but we continue to expect very healthy performance relative to broader industry benchmarks. The lending business delivered $209 million of contribution profit at a 66% margin, up from $105 million a year ago and a 51% margin. This improvement was driven by a mix shift to higher margin personal loans revenue, along with marketing and ops efficiencies, as well as fixed cost leverage across the entire segment. For the full year, lending adjusted net revenue grew 45% to $1.11 billion, and the segment delivered $664 million of contribution profit at a 60% margin. Shifting to our tech platform, where we delivered net revenue of $86 million in the quarter, up 61% year over year, or up 13% excluding Technisys. Overall, annual revenue growth was driven by 31% year-over-year Galileo account growth to 131 million in total, as well as sequential growth in transactions per active account. We also signed 11 new clients, 4 of which are in the B2B space, and 3 of which are in Mexico, further diversifying our partner base. During the quarter, one of our clients migrated the majority of their processing volumes to a pure processor, which resulted in a $6 to $7 million revenue headwind in period. Segment contribution profit of $17 million represented a 20% margin and 24% if you were to exclude Technisys. For the full year, the Tech Platform segment grew revenue 62% to $315 million and delivered $76 million of contribution profit at a 24% margin. Excluding Technisys, revenue growth was 24% year over year and contribution margin was 30%. Moving on to financial services, where net revenue of $65 million increased 195% year over year, with new all-time high revenue for SoFi Money and continued strong contributions from SoFi Credit Card, SoFi Invest, and Lending as a Service. Overall monetization continues to improve, with annualized revenue per product increasing to $40, nearly 2 times the $21 in the same prior year quarter, and up 25% sequentially from $34. We reached 6.6 million financial services products, up 60% year over year, by adding 635,000 new products in the quarter. We now have 2.2 million products in SoFi Money, 2.2 million in SoFi Invest, and 1.9 million in Relay. Contribution losses were $44 million for the quarter, which improved sequentially as a result of the growth in revenue, as well as fixed cost leverage, but increased year over year predominantly as a result of building our CECL reserves for the SoFi Credit Card business, which is expected as we continue to grow and scale. In addition, we saw a year over year reduction in higher margin digital assets revenue. For the full year, the segment delivered $168 million of revenue, which is nearly 3 times the $58 million we delivered in 2021, and our contribution losses were $199 million. Notably, that's a 21% improvement in contribution loss per average product during 2022 versus 2021. Switching to our balance sheet, where we remain very well capitalized with ample cash, excess liquidity, and strong regulatory capital and leverage ratios. This year's opening of SoFi Bank further reinforces our strength and provides more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q4, assets grew by $3.2 billion as a result of the strong growth we continue to see in personal loan originations. On the liability side, we saw tremendous growth in deposits to $7.3 billion, up $2.3 billion quarter over quarter. Because of this, we exited the quarter with $3.1 billion drawn on our $8.4 billion of warehouse facilities, which represents 36% of our total available capacity. Our current book value is $5.5 billion, and our tangible book value has grown for 2 consecutive quarters, with more than a $50 million increase sequentially in Q4. Let me finish up with guidance. Before going through the specific numbers, I want to hit on some of the larger macro assumptions that underpin our financial guide. From an interest rate perspective, we are assuming an outlook consistent with the consensus forward curve, with a peak Fed funds rate reaching approximately 5% in Q2 2023, with 2 rate cuts in the back half of the year to get us to a 4.5% exit rate in 2023. We are assuming a 2.5% contraction in GDP and a normalization of unemployment to around 5%. And from a credit perspective, we are expecting a continuation of elevated credit spreads across capital markets and a continued normalization of consumer credit. For Q1, we expect to deliver adjusted net revenue of $430 to $440 million and adjusted EBITDA of $40 to $45 million. For the full year of 2023, we expect to deliver adjusted net revenue of $1.925 to $2.0 billion, representing 25 to 30% growth, and adjusted EBITDA of $260 to $280 million. Our outlook represents 30% incremental EBITDA margins for full year 2023 versus full year of 2022. And we expect to reach quarterly GAAP net income profitability by Q4 2023, with GAAP net income incremental margins for the full year of 20%. Finally, quickly hitting on a few key points for each segment. In our lending segment, we expect the Department of Education's moratorium on federal student loan payments to extend through June 30th, 2023, at which point there are 60 days before repayments actually begin. Accordingly, our outlook assumes that we will be operating in our current run rate levels until September. After September, we do believe there will be a recovery to higher levels of student loan refinancing revenue than the current trend, but we do not expect to return to pre-COVID levels in 2023. In our personal loans business, we expect to see modest growth as we balance taking advantage of ample headroom in this business, given our current market share and differentiated product, with a thoughtful and prudent approach to ensuring our credit remains very high quality. We remain committed to underwriting to an industry-leading life of loan loss profile. In our tech platform segment, one area of focus for us in 2023 is on quality of new clients, including size, durability, and time to market over quantity, which means bigger wins that leverage the combined go-to-market value proposition of the tech platform while still investing in focused new product areas to drive diversification. While we expect low double-digit organic revenue growth in 2023 due to this focus and a variety of other factors, our longer-term strategy is already starting to pay off with greater diversification in our pipeline and significant margin expansion expected in 2023. After a 3-year investment period in the tech platform, including moving to the cloud, a 2.5x increase in headcount, the acquisition of Technisys, and launching new product capabilities, we will increasingly focus on leveraging the value of our investments through the synergies between the two product lines, Technisys and Galileo, as well as through joint product offerings, all to drive meaningful contribution profit growth relative to revenue growth. In starting to operate as one unified technology platform, we have recognized opportunities to reduce our costs, including a small reduction in headcount. In financial services, we expect continued strong growth in revenue, driven by growth in products, as well as increased monetization per product as we scale deposits, spend, and AUM. Importantly, we will front-load investments in the year to take advantage of attractive opportunities to continue to scale our high-quality deposit base. In summary, we could not be more proud of the results SoFi delivered in 2022. We exceeded $1.5 billion in annual revenue and grew adjusted EBITDA nearly 5 times to more than $140 million. We continue to be extremely well capitalized and are excited about the opportunities in front of us. We look forward to another strong year in 2023. With that, let's open it up to questions.
Thank you. Analysts will be allowed to ask one question each. Please re-enter the question queue for a second question. As a reminder, if you'd like to ask a question, please press star followed by 1 on your telephone keypad. If you would like to withdraw your question, you may press star 2. Please ensure you are muted locally when asking your question. So our first question comes from the line of Michael Ng of Goldman Sachs. Your line is now open. Please go ahead.
Hey, good morning. Thank you very much for the question. I appreciate all the color around 2023. I was just wondering if you could go into a little bit more detail around the origination assumptions. Give some detail around student loan and personal loans. Could you do that for home loans as well? Thank you very much.
Yeah, sure. So I can hit that one. Nancy can chime in. So in terms of our overall outlook on originations, going back to what I said in my prepared remarks, we are assuming modest growth in our personal loans business. We do see there being ample headroom for continued growth, given where our market share is today. Currently, we're at about a 6% market share in our credit box. That's up from about 4.5% a year ago. So significant headroom ahead of us, but we are going to take a prudent approach to this and continue to monitor credit and make changes as necessary. In student loan refinancing, we're assuming that originations are at the current run rate levels at least through the end of August of 2023. And we do expect a bit of an uptick once the moratorium ends in June, followed by a 60-day extension. And then in home loan originations, we expect to continue at the current pace that we're at right now with a potential uptick in the back half of the year as we resolve all of our fulfillment issues.
Our next question comes from the line of Dominic Gabriele of Oppenheimer. Please go ahead.
Hey guys, great results. So I just wanted to talk about the deposit growth. I mean, it's really been, Anthony, it's been really, astounding how much deposit growth you've gotten over the last year. And I'm just curious about how you think about, an environment where you may need less deposits. And and how you would go about perhaps trimming that growth rate in that environment. If, like, let's say originations are down, is it rate or is it, something else? Any color you can provide on that outlook would be excellent. Thank you so much.
I swear to God, I should be on this call.
And thank you, Dominic. We're really pleased and proud of what we've been able to achieve on the deposit side, getting to over $7 billion of deposits, starting at less than $1 billion at the beginning of the year. And that trend really reflects the strategy that we've employed behind the bank to offer a very high interest rate on checking of over 2% and a high interest rate on savings at 3.75%. No fees and complete functionality on your phone to be able to pay bills, to be able to send money to your friends, to be able to look at all of your transactions, to be able to really function all of your money movement right from our app. The combination of that plus the focus we've had on driving high quality direct deposits has driven that deposit number. What I'd say is we're nowhere close to the point in our total deposits that we would have trouble deploying them. The limit on our growth is really driven by how much resources that we have to go after it. Once people become aware of our product, the adoption is pretty strong behind that. And so the deposits that we have today could be deployed the way we have the last several quarters, one, to fund our own loans, two, to be opportunistic on opportunities related to our loans that are in the marketplace. There are several businesses we're not in today that would leverage deposits, including small, medium business loans. And being in that entire sector would require deposits as well. And we can leverage, obviously, growing deposits from small, medium businesses also. So if we get to the point that our deposits are significantly higher than they are today, we can deploy them in many, many other ways to drive a great return for the company.
Our next question comes from the line of Kevin Barker of Piper Sandler. Your line is now open. Please go ahead.
Good morning. Thanks for taking my questions. Your balance sheet's grown tremendously over the last year, partly due to the deposit growth. Could you talk about, there are differences between a held for investment versus a held for sale strategy? In particular, we've seen several companies start to come back to the securitization market in the first quarter with spreads tightening relative to late 22 numbers. I'm just trying to see, how you balance, driving net interest income versus potentially some fee or gain on sale income, and how you think about that for the rest of the year. Thank you.
Yeah, thank you for the question. We noted in the press release and prepared remarks that we hit a couple of key inflection points in the year. One of the biggest inflection points is that our NIM, our lending net interest margin revenue, is now greater than our non-interest revenue. And that's a pretty big milestone. It reflects a lot of initiatives over the last 5 years, one of which was getting the bank license and being able to use deposits to fund our loans and not have to recycle that cash through quick sales, et cetera. So we have the luxury of being able to look in the marketplace, look at our balance sheet, and make the best decisions for long-term returns. And as we've done that, we've been able to hold loans longer and generate that revenue stream that's more recurring from net interest margin. You should expect the NIM to continue to grow, both in absolute dollars and as a percentage of total revenue in the lending sector. The second big accomplishment was that for the full year, in the fourth quarter, we were able to get the NIM revenue greater than the directly attributable fixed cost of the lending business, meaning the non-interest income lending revenue wasn't needed to get to profitability at the contribution basis in Q4, which is another big milestone. But you should expect that to continue to grow. It is a revenue stream that's more visible and more consistent than gain on sale non-interest income. But we have the luxury of making the best choices based on the marketplace. I'll let Chris talk about the specifics in terms of securitizations versus whole loan sales versus holding.
Yeah, in terms of the ABS market, we're seeing the exact same trends that you highlighted in your question. Back in November, we actually did a $600 million term securitization deal at an attractive cost relative to where we expect warehouse cost of funding to be in 2023. And things have continued to improve in the overall market, in the first month of this year. So we expect to be able to access that market here in Q1 and for the rest of the year.
Our next question comes from the line of Moshe Orenbuch of Credit Suisse. Your line is now open. Please go ahead.
So maybe as a follow-up to that, Can you talk about what you actually sold during the quarter in personal and student? And did you actually buy any portfolios during the period?
Great question.
Yes, I can hit on that. So in terms of sales for the quarter, we ended up relying predominantly on deposit funding, warehouse funding, and that term securitization. We did about $200 million worth of whole loan sales and a $600 million term securitization, so about $800 million in total. In terms of loan purchases, like I said during the last quarter, having the bank with a large and growing deposit base provides us with much more flexibility and a new source of funding our loans, which allows us to grow the balance sheet and hold loans for a longer period of time. There are a few ways that we can bring loans onto the balance sheet. We can go out and pay an upfront marketing cost and originate them, or we can purchase the loans. So similar to Q3, we had the opportunity to buy some seasoned loans. This time they were in the student loan refinancing space, and these were all loans that we originally underwrote. Overall size was about half of what we did in Q3. And given the credit quality, loss profile, and return characteristics, we jumped on the opportunity as we knew the borrower best, and it will set us up for really strong net interest income in the coming quarters, given our overall cost of funding. And then we also had a few $100 million of normal course cleanup calls on some of our consolidated securitizations that were several years seasoned.
So what was that, like a $500 million student loan buy?
Eugene Simonsai, of Towers, your line is now open. Please go ahead.
Sorry, was it Eugene Simoni from MoffettNathanson? Hi, guys. How are you? Quick question from me back to the outlook for 2023. Very helpful to have the color, Chris. But I was wondering on the swing factors, let's say the factors that would allow you to go to the high end of your guide, what would be the top 2 or 3 things that you guys are looking for, that could swing the results here in 2023?
Hey there, Eugene. Thank you for the question. Chris laid out in our prepared remarks some of the underlying assumptions, both macro and micro. On the macro side, GDP growth, that's not as dour as we have in our forecast and our implications. So a stronger economy than what we have, and we think a relatively conservative, i.e. low number for GDP, a decline of about 2.5%. Unemployment we had at 5%. That's a factor. If it comes in, worse than that, that could be a negative. A tailwind would be if it settles in the 4s. And then on interest rates, we have them peaking at 5% and then coming back down to about 4.5%. If rates came back even more than 4.5% and settled in the 4% range, I think we could be at an optimal part of the curve as it relates to passing on coupons, profitability per loan, as well as the NIM that we can make relative to our deposits would be a pretty good outcome. Separate from that, for the technology platform sector, we have a really robust pipeline. It's more diverse, but more importantly, there are many clients in our pipeline that have large existing consumer bases or user bases. And to the extent that those become launched in 2023 before the second half of the year, we can benefit from upside in those large partners coming on board from the tech sector. As it relates to the financial services sector, I really believe we have a lot of upside in the invest category. We are quickly launching new products to make sure that we have some table stakes products, but also some more innovative differentiation on selection. And I think that if we're able to launch those to a receptive member base and new user base, it could be a tailwind. Second thing that could be a tailwind to invest is if the IPO market opens back up. We can underwrite IPOs. We're the sole retail distribution channel for the Rivian IPO. We've participated in the Nubank IPO. Our members want access to IPOs at IPO prices. We're uniquely providing Main Street with access to IPO prices at those IPOs at IPO prices. To the extent the calendar opens back up, we have a pipeline there as well, which helps both with adoption of the product by new users, because they want that unique selection, but it also drives incremental assets under management, which allows us to drive more revenue, monetize more. So those are some of the underlying trends that could give us a tailwind when we pass over to Chris.
Yeah, the only other thing I would add to that, Anthony, is back to one of the comments that I made a few minutes ago around credit spreads. So implied in our guidance and what I mentioned is that we're expecting to see continued elevated credit spreads throughout the year. Obviously, things are looking pretty good in January, and spreads have tightened, and the ABS market seems to be showing some signs of life. So if that continues throughout the year, there could be additional upside in the lending business as well.
Our next question comes from the line of Mahir Bhatia of Bank of America Merrill Lynch. Your line is now open. Please go ahead.
Good morning, and thank you for taking my questions. I just wanted to ask about the technology platform segment. Sounds like a little bit of maybe not change, but refinement in the strategy as you go after, you're focusing on quality of clients and bigger clients with existing bases. What are some of the implications of that strategy? And I was also curious in terms of just new product introductions or cross-sell to existing clients in that segment. Like, as we think about, your growth from here, how much of it is going to come from, cross-sell, cross-buy, if you will, in that segment versus winning some of these new large partners? Thank you.
And thank you for the question.
Useless question.
I think you characterize it appropriate in that it's a refinement of the strategy. Now that we're operating on one unified platform with both Technisys and Galileo, we can leverage the combined go-to-market, and that does drive some synergy cost savings, which is why Chris mentioned a small headcount reduction. But there are also cost savings in different areas, like marketing, when you have that unified approach, especially in the United States. In addition to that, we've made really significant investments in the tech platform over the last 3 years. We've increased headcount by 2.5x. We moved to the cloud while maintaining on-prem capabilities. The on-prem will now go away this year. We've also done a great job at adding new partners. We've been adding 20 plus partners a year. As we look at the macroeconomic environment and where we sit, we think the right strategy for the year is to focus on durable companies with large installed bases, or well-capitalized companies that we know can make the transition and that will get a great return to leverage our platform capabilities. And so that's how we're approaching the year. For the first time, we're going to have meaningful margin expansion in the tech platform to start to leverage that investment we made. But we're still investing, we're still growing. And let me give you an example of some of the areas that we've invested in that we expect to bear fruit this year and that we'll keep investing in. First and foremost, we want to diversify our products just out of a debit or interchange ACH type of product, and expand in the B2B category. We have a number of new B2B partners that are generating revenue today. Some are doing small, medium business lending. Some are simply using it for payments and for accounts receivable and accounts payable. But there's a good pipeline of other partners that have large fleets, as well as gig economy companies, et cetera. In addition to building out the B2B channel, we've also tried to add more products for consumer-facing clients. And so one of the products that we have that's been adopted is Secure Card. Another product that we've launched more recently is a fraud protection. As you think about fraud and you think about the scale of some of the partners of Galileo, they may not have the scale to invest in fraud the way that we can, and they may not have the data that we have to actually drive those models. And so we've rolled out one piece of a fraud platform that we want to make available to all of our partners. If we can help them eliminate fraud, it not only saves losses, but it actually makes their service more reliable, reduces the overhead they have in call centers, and it also allows them to hit better SLAs in servicing their customers when they do have issues that have to be solved. So it's a classic make your footprint bigger than your foot type of product. In addition to that, we're focused on things that will help them drive engagement. So we've launched a direct deposit switching product, and you'll see us continue to do more there to drive more engagement. Things like instant funding are another vehicle that makes the movement of money faster and better for our partners. And then last, we just launched our first product on both Galileo and Technisys and Sofi, which is Pay in 4. That product is now available for any of our partners. And if you think about the partners at Galileo, many of them are not playing the same segment that we are. We're at a very high-end customer with high FICO score and high income. Most of the scale in Galileo's partners is actually at the unbanked or underbanked. a pay-in-4 product is much better for them than a secure card or unsecured loan or a credit card. And that product can be launched in a turnkey fashion with a much higher interchange of about 3% compared to what they're generating at 1% in debit. It does bring with it some risk, and so we'll have to wade cautiously into that market with our partners. But it's another example of the innovation that we've driven that we now think we can get a return on revenue against. And the last thing I'll touch on is Connecta. It's not something we've talked about on the call before, but we think it's a diamond in the rough, so to speak. It's an AI-driven customer service model that uses both voice and text. And that product is one that Sofi has now adopted. And that's after Sofi did a complete RFP of all the different choices and determined Connecta to be the best choice for our company. And we'll continue to invest in that product. It's available to our partners as well. And the last thing what I'd say about our strategy related to the technology platform is that the opportunity to expand geographically is bigger than you could imagine. We have to really pace our level of investment. And while we're not expanding geographically today, there's a lot of penetration within the LATAM market, which is our area of focus, especially with Technisys in more than 12 markets, helping cross-sell Galileo's products.
Our next question comes from the line of Dan Dolby of Mizuho. Your line is now open. Please go ahead.
Hey guys, great results. Thanks for squeezing me in. Can you maybe give us some, quarterly trends on sort of particularly the three metrics, student loans, personal loans, and mortgages? Just kind of how things are trending through, say, the end of January. Thank you.
Yeah, so thanks, Dan, for the question. So we aren't providing specific views on how things are trending right now, but what I would say is on the student loan front through January, as mentioned in our guide, we expect it, to be at the existing run rate levels that we saw in Q3 and Q4. In personal loans, things are progressing as one would expect. There's a lot of headroom in that business, but we're being mindful with respect to credit. And then on the home loan side, we have made some really good progress over the course of the last 2 to 3 months in terms of some of those fulfillment issues that we've talked about previously, and things are trending in the right direction. Anthony, I don't know if there's anything you'd add there.
Yeah, the only other thing I'd add, Dan, is I did say in my prepared remarks that we're seeing the strong trend in member and product growth continue into Q1. We've, throughout the year, are constantly iterating on marketing channels, on marketing messages, on lifecycle marketing and leveraging the most efficient channels. And I feel like in the fourth quarter, it was a culmination of a lot of work over the last 2 years. And we saw the benefit of that. And as we started the new year, we continue to see that. So we feel really great about not just the growth rate in members as well as products, but the quality of those members and product adoption in addition to the cost of acquisition.
We need some further guidance on the home loan partners.
Comes from the line of Ashwin Shirvaikar of Citigroup. Your line is now open. Please go ahead.
Thank you. Congratulations on the results. Questions on the process of transfer to new fulfillment partners. And you just mentioned that the last 2-3 months have been good, Chris, but what should investors expect in terms of timeline, financial impact? It's been a few quarters this has come up, and what's the main factors that seem to be, affecting a more timely transition?
This is home loans, by the way.
Yeah, exactly.
Here, we had a partner that was helping us drive great success on the back end fulfillment side of the equation. We do the marketing to drive the demand at the top of the funnel. We do the underwriting for the loans, and after that loan is locked, we partner with a fulfillment partner to get through all the steps after that. That partner unfortunately got acquired. We were then required to make a technology platform switch with the new acquired company, which was costly and time consuming. And ultimately, the economics that entity was seeing became quite onerous as rates increased. And we realized that the economic relationship that we had was changing. We needed another partner. We started pursuing other partners, quite frankly, well before that acquisition happened, just needing diversification. And so we fast-tracked the second partner that we needed to transition to. That transition didn't happen as quickly as we would hoped. I will tell you, in the last 2 months, we've seen more progress there than we have in the last 18 months. And I'm encouraged by the progress the team has made, both in terms of the technology integration, the process flow, the ability to hit time to funding metrics and serve our members better. We're nowhere near perfect, but we're starting to move in the right direction for the first time in a while. In terms of the economic impact on the overall business, Chris was pretty clear in saying that it'll ramp throughout the year. I would think about it as more second half of the year than the first half of the year. But the team is executing in a way that I think positions us really strongly to start stepping on the gas a little bit more as it relates to demand. We've had our foot off the gas, quite frankly, because we don't want to generate demand that we can't fulfill in a high quality way. And we're starting to get to the point, I think we'll be there by the second half of the year where we could step on the gas and start to see a much bigger market share gain there. We have such small market share, even with higher interest rates. I think there's a huge opportunity for us to drive revenue there, as well as that revenue being profitable. In addition to that, we do at some point, similar to the rest of our businesses, want to own it end to end. We own lending from metal to glass, so to speak, and it gives us such advantages on iterating, on testing, on pricing, on credit, on user flow, on fraud, on risk. And we see the same thing now in SoFi Money, owning Galileo and having the benefit of Technisys as well. And so at some point in home loans, we'll own the back end also. We will always partner. It's great to have two sources of capacity, especially given our aspirations and how big we think this could be. It is a huge financial transaction for our members. It is an emotional transaction, and we need to be able to scale it and meet the needs of all of our members, and that's where we're focused on long term.
Our next question comes from the line of John Hecht of Jefferies. Your line is now open. Please go ahead.
Hey guys, thanks for taking our questions and congratulations on the quarter. Anthony, you talked about B2B customers signing up, and you guys have had good, really good momentum out of numbers. But I'm just wondering, can you characterize the recent inflows of customers and members, any change in terms of marketing and customer acquisition activities from prior quarters, and how do you think about any changes and opportunities in 2023?
Can you explain marketing for B2B side?
I don't want to guess what your question was. Maybe you could dial back in with a better connection. I heard something about B2B, and then it was pretty muted after that.
Is this better? Sorry, guys. Is this better?
Yeah, perfect. Thank you.
I'm sorry. Can you hear me now?
Yes, we can hear you.
Okay. I apologize, guys. My headphones are bad. The question was just, Anthony, you mentioned B2B activity. You guys clearly still have very positive momentum with new members and new customers. I'm wondering, given your channels of customer acquisition, the cost of customer acquisition, has there anything changed from a characteristic perspective? And how do you look at opportunities from that regard in 2023?
Yeah, so the SMB opportunity, I think, is really a opportunity that's aligned with the type of member that we're acquiring in our core target. We don't have plans in 2023 to enter that market. We do believe it's an opportunity for us over the longer term to serve that market well. If you follow us on any social media, it's a constant request that we get from people to launch small, medium business checking and savings, small, medium business lending. When the pandemic first started back in 2020, March time period, we were inundated with tons of small, medium businesses coming onto SoFi and trying to apply for PPP loans. We clearly don't have small, medium lending. Now that we have a banking license, that is an area that we could go into, but we didn't at that point in time. We stood up a website that allowed us to take the traffic that came to SoFi and leverage Lantern to send the traffic to a marketplace of small, medium business lenders. And it was people were very happy with it. The demand as a result of that led us to realize that many of our members are operating small, medium businesses and that we could serve them on the commercial side as well. But as I mentioned, it's not something that we do in 2023. I would never say, that would stay the same. We'll review it every quarter. If the student loan market came back sooner than expected and some of the other things went our way in the economy and so forth, it may be something that we could focus on in the second half of the year. But right now, it's not on the funding list, but it's a huge opportunity for us. The only reason I mentioned it earlier was we'd been asked the question earlier about deposits and what happens if they grow too big. And that would be a great problem to have. If they grow in excess of what we're willing to originate on the personal loan side and SLR side and home loan side and credit cards, we would offer more lending products to make sure we're capturing that great resource of deposits to deploy against high returning assets.
I don't believe he's being very honest there, but
Comes from the line of Michael Perito of Stifel. Your line is now open. Please go ahead.
Hey, good morning. Thanks for taking my question. Yeah, obviously you guys have hit on a lot already this morning. I thought maybe I'd just ask Chris, just can you maybe give us a reminder, some context around how you guys are thinking of capital of the bank in your 2023 projections? Obviously very healthy still today, but imagine, in the guide there's a bit of balance sheet growth baked in as you guys done in 2022, and just curious where you kind of have the capital ratios levering to and how that compares to kind of where you want to run the bank normalized going forward.
Yeah, thanks, Mike, for the question. So I'm not going to be providing guidance on the balance sheet size within the bank, but I'll at least provide a little bit of insight in how we're thinking about it. So right now, we've capitalized the bank with about $1 billion of capital. You'll see that in the bank call report that comes out later today. We're currently operating at about a 15% leverage ratio, which is still significantly above our regulatory limits. So we do expect to see additional balance sheet growth as we continue to scale our lending business. We expect modest growth in our personal loans business and then relatively muted in the student loan refinancing and some growth in home loans. The only other thing I would add in terms of being able to grow the bank balance sheet is that we are sufficiently capitalized at the parent as well. We're coming off of a year in 2021 of raising over $3.5 billion of capital, and we've only deployed $1 billion of that to the bank. So we have sufficient excess liquidity that we could capitalize the bank and grow it further if we wanted to.
And the only thing I would add on to that is something we were talking about as a team yesterday that doesn't get a lot of attention. But when you look at the asset side of our balance sheet, and you look at the trend, and you look at our cash and cash equivalents, we finished the year at $1.4 billion of cash and cash equivalents. What's not in that number is $424 million of restricted cash. And then there's some investment securities, which is a combination of treasuries and government securities, as well as loans or resids of about $400 million. The trend in that line has been continuing to increase, which speaks not only to the liquidity that we have, but the equity that we have that we can deploy either against funding loans or funding the bank. And it's one of the important measures that will continue to give you somewhat of a level of confidence on being able to fund the bank to grow more if we need to put more equity there. Great, thank you for dialing in today. I wanted to end with a couple of comments. February marks my 5-year anniversary at SoFi. And it's just very humbling what we've achieved during such an unprecedented time period, growing from less than $500 million in revenue to $1.5 billion at the end of 2022, 600,000 members to 5.2 million members, and negative adjusted EBITDA to $140 million of EBITDA, plus raising $3.6 billion in capital, becoming a public company, and receiving a federal bank license. But to have done all of that through 2 interest rate cycles, a recession with the potential for another, a global pandemic, inflation at a 40-year high, and in an incredibly competitive environment with significant access to near zero cost of capital is a remarkable 5-year run. None of this, though, happens without the full faith of our board and our shareholders, the persistent and unrelenting resolve of our people, and a team that has done nothing short of the extraordinary. Many can prognosticate about what lies ahead for the economy, interest rates, but in my view, the political background, the regulatory background remain very uncertain. And those exogenous factors are out of our control. But as it relates to what lies ahead, I will simply state my strongest belief that SoFi continues to be the best positioned company to be the winner that takes most in the digital financial services sector of the future. Reaching that outcome is what we control and what we remain steadfastly focused on to achieve. With that, thank you for calling in and listening to our fourth quarter results as well as our 2022 full year results. We'll talk to you next quarter. Thank you.
All right. Lots of notes during that one. Where do we want to start?
So much fun. I want to start right at the end there because that just got me so hyped up. That's like the Wolf of Wall Street. Like, I'm not leaving. Like, this guy continues. I hate to bring up the only bear that we know about in this stock. But, you know, Darth Chris likes to say that we haven't gone through a recession. We've gone through more than most companies and continuing to hit it out of the park. And I just want to say one big thing before I lead it off to you guys. This really does solidify us as the last lender standing. Like every other lender dropped off this quarter and we did not. And we're holding up and we are expecting really, once again, I'm not too proud of it, but it is conservative guidance. They're expecting really conservative things. So if anything switches onto the good side, it's going to be a massive positive for SoFi. Last lender standing, baby.
Okay. Tevis, your raw thoughts after hearing this earnings call?
Yeah, very bullish stuff. I think they had a lot of insight into 2023. I mean, the analysts asked it like 17 freaking times, the same question, but they basically provided a lot in terms of where they expect the economy. Look, I think the thing that surprised me the most is that they're expecting rate cuts in 2023. Did I hear that correctly? Am I making that up? I thought I heard
They are.
it.
All banks are. All banks are like most of them are expecting 2 rate hikes and then 2 rate decline or 2 rate cuts after. That's pretty in line with everyone else.
That's okay.
So everyone thinks the Fed is going to cut, or the banks at least think that the Fed is lying.
Well, I guess, because I'm going off of like what the Fed said, and they're like, we're not cutting in 23, maybe 24. So we'll see how that goes because they've baked that into their expectations for numbers. And so if the Fed doesn't cut, then that could be a rough time in the second half of the year. And then in terms of the B2B side as well, I know Riley's going to have something to say about the partnerships in Latin America, that expansion, the SMB point, which they're expecting it in 2024. We can talk a little bit about that. I took a bunch of notes here, so we can jump to a bunch of different places wherever we want.
Okay, Riley, your overall thoughts?
I mean, it was good. I wish they talk about the tech side more often. One thing that stuck out was that they're moving off-prem pretty soon this year. So they're expecting to be fully integrated in the cloud, which is really good for the developers. More people focused on.
Do we know what cloud they're using?
Azure.
I think Technisys and Azure have a good relationship.
But
so that everyone knows, on-prem is on premises. So meaning that they have computers in-house.
Physical servers.
Yeah.
They also, just on that point, Riley, increased headcount 2.5x on the tech platform side.
They're planning, or they just did?
Well, this was in response to the Merrill Lynch question. So I'm not sure if it was their planning or they just did, which is interesting because I thought Chris Lapointe in his remarks highlighted, or to one of the questions earlier, highlighted that they did a couple of cuts to workforce because Technisys and Galileo are now operating as one tech platform as opposed to two. And so after they merged, there are redundancies in a couple of the roles. And so just fine tuning that. So it might be that they're planning to increase headcount from 2.5x. He said it in the same breath that he said the on-prem to cloud. So if that was something that's expected in 2023, then this is probably expected as well.
That should be really good news, meaning they're not worrying about integration. They're worrying about developing actually new products. They did say, Noda did say that they were planning for a bunch of things happening in the investment platform, like differentiated products to make us look more valuable. Because I'm sure Noda knows that one of the biggest top funnel to get all these new customers in is the invest platform associated with the bank. So that would be really cool if by the end of 2023 it looks better, cleaner, or it has some new products. I don't know. That'd be really good.
You guys want to hear something crazy? They said the average FICO score on our personal loan side was 747.
Wow.
Okay. And then our SoFi Money average FICO was 745.
Mm-hmm.
Wow, that is
Yeah.
crazy, because the cross-selling ability means that a much higher percentage of the people are going to be able to actually be approved for a personal loan when they need it, right? And that's really exciting. And then the reason why they think this is happening is because of higher interest rates. Because people who are actually wanting their money to be right, getting the 3.75% in their checkings, rather than just having a bank relationship just because that's what they know, they are probably more financially literate and care about their money. And so they're going to naturally have a higher FICO.
Yeah.
And so
Student
the
loans was
idea of
even higher.
delinquency, and I was just going to say the idea, go ahead, Tanner. You got Tevis.
Tevis. I was just going to say student loans was even higher than that, 773 on the FICOs. Go ahead, Amit.
Yeah, I was just going to say that. So the rate of delinquencies and defaults on loans is probably, I mean, less just because we have smarter people doing it or more qualified people versus some of the other banks.
Meaning what? Sorry, say that again.
The idea that we would have people would default on their loans, given the high FICO scores of the members that we have, potentially means it's not like that's not going to happen. But if we do have a major recession, maybe these people are financially literate enough to not have to default on their loan.
Absolutely.
Not even necessarily that, right? Like they just have fewer outstanding like debts, right? Because a portion of your FICO is your debt ratio. I mean, Tanner might know this better than I, but like your debt ratio, essentially, what is my credit limit? Let's say that's 10,000, and how much am I utilizing that limit? And if I'm utilizing it 1,000, that's 10%. That's much better than if I have 5,000 out of 10,000 that I'm currently owing. So the higher the FICO scores, generally the better the financial state that they're in from a debt or money owing perspective. And when hard times hit, the people who are already, strapped up with debt, they don't have any wiggle room. And so they're the first to default. And the people with high FICO scores are generally a little bit more resilient because they've had a lot of cushion.
Right. And like, it's so funny whenever you look at Lending Club and people go, oh, well, they lend to really high end users, right? They're not for the everyday consumer. You probably need to go somewhere else for your everyday personal loan. But for Lending Club, you're going to need to make $116,000 a year on average, 116,000, and like I think it was 715 FICOs. Okay, well at SoFi we even step it up a notch. We do 165,000 and 747 FICO scores. So the importance is that if things start to collapse, the idea is that the people who are subprime on their lending, which was what a FICO score is to try to judge where we can, sort of place these people on a delinquency rate, and then apply a higher interest rate based on, lending standards. So with SoFi, it's technically like these are the last people to stop paying their loans, depending on how high or how bad the recession actually gets. So we are very, very safe whenever it comes to this. And then even in this earnings call, they even said, we're being even more conservative. Like we know that things are going to return to recession levels. They're aware of all these things. They're actually not being dumb about it. They're just, being very conservative and very excited about their growth. And one of the easiest ways to look at this, sorry, IP banking research, you're not going to agree with me, but it's in the deposit growth. Every bank is shrinking. We are growing. And the analysts that are saying, wow, great quarter, and then, future downgrades or whatever, which is the truth. But they see it. They're going, okay, but this is growing so fast. How can you sustain it? Like that is a good problem to have. And now Noto is he's being a little cheeky. He said, well, we'll just create new lending products. No, you're not. I don't believe you. Like that can't happen forever because you need buyers for those lending products. We hold for sale, right? So we sell all our loans. You need buyers. So the market, if we are going into a recession, buyers shrink down. People don't want fixed income products, if things are going to actually happen to increase in delinquency rates. And if they can still sell the loans, then they're going to be at a higher discount. This is what, Darth Chris is complaining about. I just don't think that his numbers are he thinks it's going to be doom and gloom. And I don't apply that anywhere.
What was Noto saying at the end when he said we can turn up demand if we want, but we're trying to be conservative on demand? Did you guys hear that part where he was basically, we can rank up our member growth, but we're not trying to market as aggressively for, and I think it's because Tannor, you called it. It was about profitability versus growth.
Yeah. And I thought it was funny that I said, you know what, we really need to ask about the home loan partners. And then it literally was the next question, which I'm pretty sure, I don't know this 100%, but I'm pretty sure that lender, someone in the chat said it was Pagaya. That's incorrect. Okay. What I think it is, it's lower.com. That's what I think that lender is. And I'm pretty sure they're messing up. They're
the one that got bought out.
Sorry?
The one that got bought out, lower.com.
I don't know who they got bought out by. They're I was just actually looking at them. They're starting, like in recent news, they're partnering with Open Door. So I don't follow Open Door enough to know if they actually got acquired by them or anything along these lines. But it seems like they're switching over to some new process. And I'm almost certain that is the lender that they're talking about, which we also invested in. But they are just not, living up to our standards. They're switching over their platforms and making us pay the price for that. That's what they said on this earnings call. So I really appreciate the little bit of extra guidance. They're sort of saying why we're having a problem with this home lender, and actually potentially building something internally because they have so much control over their personal loan and their student loan platforms. Like, student loans would be absolutely amazing if there was the demand for it. There's zero demand for it. And, we're still seeing a little bit of an uptick, but that's the only problem is our home loans are just shot because our partners are just dropping the floor out from under us. If we can actually make that internal, we have full control and the demand will come back.
Yeah. So just to go back to Amit's earlier point, I'm just looking at the notes. So what he was saying to the last question was they capitalized the bank with 1 billion, but they have excess liquidity because I think they raised like 3.6 billion or something like that. 15% leverage ratio, which is above the regulatory limit, but they expect to have additional balance sheet growth in lending. And since they have excess liquidity that they can further capitalize the bank should they need to, they can grow it further if they need to. So that's where that point came from. And then he was also talking about the balance sheet trend in terms of like 1.4 billion in cash and cash equivalents and that trend continuing. But going back to home loans, and I found it interesting that that transition was taking so long. I mean, he said we've done more in the last 2 months than we've done in 18 months, and they still expect this to complete in the second half of 2023. So a couple points there. I mean, number one, having these migrations is freaking hard because it's not only depending on Sofi, it's also depending on that other partner to collaborate with them on that transition. And then number two, I mean, it opens a door for saying, okay, well, now that they're actually having that goal, which Noto reiterated a couple of times in answering these questions, he said, look, with home loans as well, we want to be an end-to-end provider, and we think that that's going to happen. So that opens a door for saying, well, they've already seen what happens with an external dependency once with this company that got bought out, and now it's forcing Sofi into this like 2-year plus process of transitioning out and being hurt because of that. It'll further lead them to the way of like, we need to buy out this company entirely. And so it leads me to believe that the fulfillment partner for home loans is a company that they're seeing as an acquisition target in the near future. I mean, obviously once they finish that transition, probably 2024, but that's still like, if you read between the lines, the writing's on the wall for, we don't want to run into this again. It took us 2 years to do it. We want to be end to end with this process, and they've acquired other companies in the past that help them further their goals. So it just seems pretty clear on that front.
Okay. I think we're ending it here. This was pretty exciting. We got a lot to talk about on our SoFi weekly podcast on Friday. Thank you, 560 people, for being here, just staring at us while we listen to a blank audio page, trying to understand what the heck is going on with this company. The stock right now, I believe we have 12 minutes till market open.
Do we want to go to market open?
I mean, I'm going to do the market open. So if you guys want to stay for the market open, we can do the market. It's up to you guys.
All right, I'll stay for the open.
Okay, so Tevis and me will be doing the opening. Cool, perfect. Tannor and Riley, you can stay if you want, but if you want to leave, that's fine as well. So it's at 6:47 right now. What is this? 0.31. No, that's Tesla. Up 9.09%. Obviously heard a lot of interesting things.
Definitely recovered after the call because
yes,
you could see the points there when the initial report was released. It just shot up to 675 and then shot back down and then gradually increased after the call. So that's definitely good news. But the market is seeming negative today from just the pre-market numbers that I'm seeing. So we'll see where it opens at. I'm kind of interested.
Okay, you know what? For me, and I don't do any technical analysis, so I don't care what the market's doing. But what I would assume is happening is people ran up whenever they saw the initial release. It dropped down whenever they saw guidance, and then it went back up whenever we got Noto's explanation. and that's pretty much what we saw, is that he's being conservative once again, and saying so. They are expecting the full term of the student loan pause to happen, including the 60 days, and then expecting it back in September. That can happen earlier, but he's not guiding for that at all. So, yeah.
All right. So let me ask you guys this, because I really enjoyed the game that we played on member growth. In the Q&A portion of that call, we had Goldman Sachs, Oppenheimer, Piper Sandler, Credit Suisse, MoffettNathanson, Merrill Lynch, Mizuho, Citi, Jefferies, and another one. Michael Perito was the analyst name. I don't know what the institution was. So 10. How many of those 10 in the next month do we think are going to reiterate their buy ratings but lower their price targets? Just wild guess.
I don't. Yeah, I've got no idea.
I would say 5 of them.
You think 5 lower buy ratings? Cool.
I don't know. I in 2022, I was really skeptical about like how they were doing this, because it just seemed like they were pulling a lot of cheap shots on SoFi. I don't know. Doesn't it? If the market continues to go up, I feel like they're going to raise it. It's going to be all contingent on macro. So I don't know. Maybe I'll echo Amit's guess, 5.
Okay. Well, it's 9:20, so this is when we start the market open. So now that I have you guys here, I can just play with you guys and ask you guys some questions around.
Change the title.
Change the title. But see, this is the weird part. It's like that's what I was going to start a different stream, but whatever. We'll just keep it in this one. Okay, so SoFi's up 10.2%, $6.55. We're into the 650s. We've got everything else red except Tesla, which is up 0.12% pre-market. So I guess question: do you think Tesla maintains the rally this week?
Love it. Have you seen my shirt this morning?
Oh, wow. You got a Tesla shirt.
Of course, I wore a Tesla shirt to the SoFi earnings call.
I didn't even see.
Didn't plan that.
By the way, I got to say, it is really weird saying SoFi is at $6.50.
Why?
Because it's been such a long time. We were in the $4 and it immediately just jumped up. Feels good.
I should have bought more at 4.
Yeah, I say this all the time, but like if a stock actually does end up falling down into the $4.30 ranges, like would you have rather it never gone down there or just stay stagnant at $6.50? I mean, the truth is this has been amazing. We've been able to get shares of a company that is still performing great at lower prices. This is an instant boost in my overall portfolio, because I'm buying a stock that was down previously that I knew would come back up. And I mean, it could go back down there again. But unless the company actually changes what they're saying, and something that I see from the stock is not what I like, but that's not what I'm seeing at all. Everything that I said was going to happen happened. That's perfectly in range with my guidance. So of course I'm going to continue to hold the stock. Like there's in fact, it beat all my member expectations by 1,000 members, right? So I'm even more excited. Like, and that's the way you should be looking at it. Stop looking at the charts. It doesn't matter. Beautiful things are happening. Go ahead, Amit. Take us in.
Oh, that's really good. I mean, the fact that we got it at 4. So what you're saying is nothing materially changed in their business when we dropped down to 4, other than the macro. But we got it for better prices and for better growth. Let me ask you guys a question about the Fed. So we have CPI coming, or not CPI, the rate hikes coming in on Wednesday. Is it a lot of people are saying 50, but a lot of people are feeling that the Fed just can't do 50 given how good things are from a CPI perspective, decreasing month over month. Do you think there's any shot we get 25?
Yes,
basis
definitely.
points?
Yeah, definitely.
You think it's more likely than 50?
Probably.
Because that's my question.
I
actually
would
think
say
they're
at
going
this
to go 50.
point, yes.
Yeah, I
Yeah,
mean,
I'm
look,
going to guess 25 basis points.
look at the trends, right? Like employment numbers came in pretty strong. I think a lot of the numbers with regards to just the economy just came back really strong over the past couple of weeks. Employment is the only one that's coming to mind, but that came back like really strong, if I'm not mistaken. So, that just gives the Fed more ammo. And then we've been having a rally in January as well. So it just gives the Fed more ammo to just, bump up the rates. I'm not saying that's the right move. Probably I would lean towards going softer and more gradual as opposed to like hitting it hard because they're operating on some lagging indicators to judge what to increase it by. But I mean, I think the fact that we're going to have a rate hike is pretty much priced in. Like nobody's expecting no rate hike. It's just a matter of like how severe is that going to be. But at the same time, I don't necessarily know how the market's going to respond to it. It's pretty priced in, I think, at this point.
Okay. We have 5 minutes till market open. Let me ask you guys a different question that's big in the news. TikTok CEO testifying before House panel about app security and ties to China. Gun to your head, do you think this app gets banned from the United States?
Yes.
I think two things are going to happen. It has to either get banned or acquired and completely owned by American companies.
Yes, exactly.
Yeah, that's what has to happen because there's obviously too much risk here, and it's seeming like no investor is touching this stock, and it's getting downgraded like crazy. I think at one point the valuation for TikTok was 320 billion, and now no one will touch it even in the 3 digits. Or sorry, what is that? 12 digits?
Yeah.
But no one's touching it in the even under 100 billion. So that's a crazy markdown, and it's losing steam.
It's already gotten banned in a couple of states, right? From schools and like from government devices and a whole bunch of like little localities. So I think the next step is just like that's the start of a momentum of a wave that will eventually get it banned in the US. I think the wild card, like Tannor mentioned, is if somebody, a US entity goes ahead and buys it and provides more visibility into all the metrics. I mean, Oracle was the candidate back in 2020, I think it was 2021. Oracle, I think, bought a portion of ByteDance or was in a bid to buy TikTok, something like that.
Yeah.
But that never really materialized. So if that happens, then great. If it doesn't happen, I think lawmakers are pretty gung-ho on banning it now, especially after it's already been banned in a couple localities. I think that the next step over is an incremental one, relatively speaking.
If this happens, which U.S. tech company benefits the most off a TikTok ban?
Facebook. Instagram.
You don't think it's Google? You don't think YouTube gets more of that video attention? You think Instagram gets it?
Well, Reels came out before Shorts did, and more people go to Instagram, for that type of content than they do to YouTube. I would imagine. So like that's the gut response, right?
Yeah, I find it hard to pick a single winner. I think the whole market will rise, and even new players as well. Like I don't think that I think even Elon Musk said this. Like, hey, should I bring Vine back? Like, I just think even that name sort of symbolizes something along the lines of TikTok, right? And there might be a shift there as well. Who knows? But I think it is positive regardless. And the fact that it is being banned in places and there's no pushback for government devices or schools, these sorts of things in certain states, allows other members to also, bring up a ban for larger and larger areas, and that will pick up steam. And yeah, that's the only problem. And then if you are a TikTok creator, I would just think, move over to Shorts. The monetization is going to be better. The user base will is increasing, and could be a great place to start.
And this is an interesting point too on that creator economy. I think Twitter is going to be like a wild card for 2023 if the execution is there, because if YouTube takes 45% of the cut from creators. All right, bye, Riley. I think Riley has a meeting.
Yeah, guys, sorry about that. I'll see you guys later.
No
Bye,
worries.
Riley.
Thanks for being here, Riley.
See you,
Bye.
buddy. If YouTube takes 45% of the cut from creators, and then Twitter comes out and they say, hey, look, we want to incentivize competition between Twitter and Google, and we're only going to take 10% of the cut, then what do you think is going to happen? All the creators are, if not migrating to Twitter completely, they're at least going to cross-post all of their content on Twitter. And all of a sudden, content drives attention. Attention drives that spread in terms of revenue, advertiser dollars. And so I think that Twitter is in a prime position right now, if they want to compete with Google, to become the place for creators to go to, because that monetization is going to be so favorable for creators, right? So, I think
all right, got to cut you off there because it is 9:30 a.m., January 30th. My brothers are here with me for me to do this. The stock market is now open. Woo! Wake your ass up. Hopefully that woke you guys up. We've got SoFi stock, $6.55, up 10% at market open. Let's give it a couple minutes and see how badly it declines or if the market can maintain the momentum. And we'll go from there. Microsoft at 245 down 1.16%. Tesla up 0.37% at 178, holding on strong, being up 70% for the month. NVIDIA at 200 down from 202 on Friday, but NVIDIA still not doing badly at a 62 PE right now. So if you're willing to pay that plus a 85 PE trailing 12 months, then NVIDIA might be a value stock for you. Meta at 149, SoFi still 653, Teladoc 29, Palantir at 750, down 0.79%. Palantir had an amazing run on Friday, as with the rest of the market, and now it is staying relatively flat. Netflix at 358. This is a company I'm struggling. Should I buy puts on this company? Because I do not believe in it. Definitely don't believe trading at 104 times price to free cash flow, but that's a conversation for another day. ARK at 39. Nice recovery from 29. Now touching close to $40, down 1.28%. Alibaba up at $111. NASDAQ breaking past 11,300, 11,516. What recession are we talking about? Let's go to the S&P. The S&P at 403, down from 405 last week, but still above the 400. So a nice little psychological barrier. Let's go back to SoFi. What are your guys' thoughts? SoFi is up 13%.
Yeah, it's starting to run.
There we go. Ooh. It's running. It's running.
It's just if it can survive, till the end of the day. That was really the bearer of bad news for Q3. We saw like a massive run up, and then just throughout the day it trickled back down after 10:30 or something along these lines. So, but very exciting. I'm happy to have it. I've got all the shares I need, and I'll probably continue to buy small shares as it rises, but I always find it hard to buy in the green. So,
yeah, I would say that like the make or break, like, so if I can close 6% up on the day or it can close 20% up on the day, the make or break is like, how is the rest of the market? Is it going to be a green day or a red day? Because the market can just drag this down. And so that's the thing that I'm tracking is like, are most stocks moving up in the open or not?
Yeah, this is interesting, man. Go ahead, Tanner.
No, I was just going to say that Q4 is different than all the other quarters because there's much more guidance, right? So people can see a longer term of the stock instead of just getting, Q1 through 3, we can only see what the rest of the year is going to hold. Now we can see what the next 4 quarters are expected to hold. And so investors can make a little bit more of a, educated guess on what they think is going to happen, which means that, a lot more insight this quarter rather than every other one. And so far, obviously, as you can see, the market is loving it. And the craziest thing is this is just, single day, right? If you actually look back in just the last couple of weeks, this is an absolute run. Like this is going from $4 and, 50 cents ish all the way up where we might even hit, potentially $7. Massive increase.
Look at this, 685 up 15 freaking percent. My goodness. That is not bad. That is not bad at all. So SoFi is up at 687. I wanted to go to Lending Club real quick just to show. I know they're not exactly the same companies, but Lending Club IPO'd at 146 back in 2014, and currently it's at $9.78. So, I mean, for a financial services company, I know it doesn't offer everything SoFi does, but it seems like SoFi might have a much better trajectory against other fintech companies, financial service companies over the next 10 years versus something like a lending club at the end of the day.
It's looking really strong at the open. Just looking at the candlesticks right now. Just four really nice.
But this is what separates the difference between these bank only investors like on Seeking Alpha that we've covered. I'll just say IP Banking Research, where he has extremely strong buys on Lending Club and then like sell ratings. Actually, I want to be fair to him. He has a hold rating on SoFi. He's just indecisive on the company. But the truth is that this company is growing faster, and it's because they put customers forward, right? Because we're offering such a higher APY, interest on your money in our checking account versus something like a Lending Club, which is trying to promote higher margins. The margins aren't what make or break it. Like, we want a stronger company that customers stay around for a longer period of time. So putting customers forward increases a customer lifetime value, and you're going to see that throughout this next year. And you already are seeing it, because although we actually have smaller margins than Lending Club, we actually have, a much better earnings results than we were expecting, because we can prioritize profitability in other areas. And so it'll be perfectly fine.
I just checked on my call options. They're up like 75%-ish. So I'm pretty happy.
When do they expire?
I bought Leaps, so they're January 2025s.
Okay, quickly, any thoughts on Lucid buyout rumors from the Saudis? You guys think it could happen? Interested in this?
Doesn't Saudi already own over 50%?
Well, they were going to buy out the rest, and that's why the stock rallied.
Got it.
So
gotcha. I don't want to talk too much about Lucid. I'm not a big fan, just because I'm a big Tesla buff, and I've got no love for Lucid.
Do you own Tesla?
Yep.
My guy.
Okay. Pretty cool.
I mean, are you the only one now that doesn't own Tesla?
No, I have Tesla.
You do Tesla.
Yeah, I have like 20, 25 shares. It's not a lot, but
I thought you had like 8 shares. So
no, it's more than 8 shares.
Gotcha.
So I'll tell you right now. How many do I have? I have 12 shares. I have to go to my SoFi account. I think I have like 10 there on there. Okay. I'm so salty, bro, because I bought Tesla at the low levels in fucking 2019 at fucking 300 pre-split. And then my stupid friend, I bought it at 170. I sold at 300 because my stupid friend was like, well, you should take profits. And I was like, why? He was like, well, that's how you approach the stock market. You're up, 100%, you take profits. And I just knew nothing about Tesla, and I sold it for $150. It's just so stupid. And so I've always been salty around not holding on to Tesla. Let's take a look at some of the talking heads. Let's listen to tech is a good place for. Well, no. Let's listen to this. Let's talk a little bit more about potentially interest rates. So let's hear about this with 25 basis points potentially coming up. Here we go.
Yeah, we're going to add another voice to the conversation. Roger Ferguson, well known to our viewers, former vice chairman of the Federal Reserve. He's also the former CEO of TIAA and a CNBC contributor. Roger, it's great to see you. Good morning.
Good morning. Nice to be here.
The economy has been something of a Rorschach test for, looking at the same sets of data and looking at the same market performances, but having different interpretations. You have one school of thought. We just heard from Mohamed El-Arian. The Fed needs to hike faster and steeper until essentially there's more pain in the stock market. And then you have others like, Chair Powell and Larry Summers and others who are suggesting that, hey, maybe we need to slow it down because the economy is too murky. What school of thought are you in?
I think I'm more in the latter school of thought. And the reason is that the Fed has moved very, very quickly, historically rapid pace. They've gotten rates into what I think they believe to be restrictive territory. They are starting to see the economy slowing. Already goods inflation is way down. And so I think the Fed at this stage is feeling much more comfortable than it was, back in the summer, and therefore more likely to move at a gradual 25 basis point pace for the next 2, maybe 3 meetings.
Okay, so that's interesting and important, but there's someone else who also thinks it could be 25 basis points, and honestly, he's a bit more exciting to listen to. So let's take a listen to him.
Well,
I never saw so many people so bearish. And I think, as I mentioned, when everyone's on one side of the market's going to do the opposite thing. So much bearishness is built in that any crumb of good news, such as the inflation news that we've been getting, interpreted positively by the market, and of course the hope of a pivot by the Fed. Next week is critically important. We have to get no more than 25 basis points. 50 would be, I think, a disaster. We need to get 25, but we also need to get the messaging that not only does the Fed see that their policy is working, but that they are very near the end of their tightening, not, oh, we have more work to do. I don't think the market will take those words very well. I think 25 basis points is all they should do. After all, by the way, we got the December money supply, Scott, which is, as you know, something that I look at closely. 2022, the lowest growth of the money supply since the Great Depression of the 1930s. Now, that's something to think about. We have the greatest inversion of the Treasury yield curve in over 40 years, the most reliable single indicator of a recession. That's something to think about. Why would the Fed want to continue and even increase the inversion of the yield curve?
First of all, why are his eyes closed all the time?
I love him so much with all my heart. But he's right. And the only thing that I would say differently, and I could be wrong, but I think that the Fed knows what they're doing. I'm a believer that they know that 25 basis points is what's needed, but they are still talking as if there's more work to be done. So then people don't go back to instant spending. I think the talk is going to be much higher than the actual actions. Bark bigger than their bite. And
what do you mean by so people don't go back to their
elicit
spending?
a response?
What do you mean by that?
Sorry?
What do you mean by people? What do you mean by people don't go back to their spending? That's why the Fed is talking the way they're talking.
I think that they don't want to get people excited. If you say that inflation's slowing, that can cause inflation. If you say, oh, actually, things are going back to normal, you guys can still book your vacation trips, go back, everything's fine, that actually is not what they want. They're going, no, it's going to get much worse from here. Continue to not spend, because that's what's causing this. Okay. So I think that they are saying things are bad. We have a lot of work to do. 25 basis points. and that's why I think banks and everyone are saying that there's going to be 2 small rate hikes to continue, and then reversing that trend, because he's right. We are right at the end of this. At least that's how I see it. I can't say that he's right, but he is right in the way that that's also what I'm predicting as well.
Yeah, I mean, look, yes, to a certain degree, but also their bite has been pretty bad over 2022. This has been the fastest, rate hike. It's unprecedented. And I just think to myself, how would this market look differently if they did the same amount of rate hikes over a 2-year period as opposed to a 1-year period? Because what's happening now is like everybody is thinking, okay, max, there's going to be 2 more hikes, whether they are 50 or 25. But realistically speaking, everybody's thinking that there's not going to be any more hikes by the end of 2023 because they would completely tank everything. And so people are preempting that. And maybe we'll have 25 this time, maybe we have 50. And then next time, we'll probably have 25 or nothing at all. And then what happens? Like, people want to be the front in line to catch that bottom, so to speak, when the market comes back around. And so I just think that it just caused a really sharp drop, and it's going to cause a really sharp increase again, especially if SoFi is right and they do rate hikes towards the end of the year. That rally is going to be insane.
Mm-hmm. Yeah, but I think that's why you're seeing a lot of these stocks, very, very risky stocks, starting to see a large increase in the past month or past 6 weeks. You look at Tesla, you look at Coinbase, these are very speculative companies. Well, definitely Coinbase more than Tesla, because the unprofitability, but it's just the companies that I've been following recently, and just massive increases in the price of the stocks. So that's a very good sign that the market is starting to, weigh heavier on risk on assets.
Coinbase is basically up 100% in the past like month and a half, which is not bad.
Not quite 100, but it is incredible how fast it ran.
Glitch Life says, stop looking at the noise, pay attention to the macro. We printed multiple trillions of dollars. There's no price stability. The Fed has to hike until deflation occurs to restore price stability. This is interesting because I think that Cathys and the Elons of the world feel that deflation is already here and it's happening, and we're seeing it within the CPI and things of that nature. So it's just a question of when the Fed wants to recognize that and then take action.
Yeah, exactly. That's right on the money, Amit. And we know the Fed is operating on lagging indicators, and that's why earnings are so important. And especially this week, earnings is going to be important because FANG reports.
Yep.
And we're basically going to hear from these CEOs as to what they're seeing in the market. Like SoFi just gave their guidance in terms of what they're seeing and why their guidance is the way it is, because they can actually see it in real time, whereas the Fed sees it maybe 3 months, behind at a lag. So deflation could very well already be here. At least I think, just from Tesla's earnings last week, we did hear, a similar sentiment around the supply chain, specifically with regards to deflation.
Yeah, Elon's been talking about it for a while. All right, last thing before you guys get out of here and we'll end the stream is FANG earnings. Which one? We got Google, Apple, and Meta, and that's it, right? This week? Yes. So Apple did $90 billion of revenue last year or last quarter. Google did $69 billion and Meta did $28 billion. Which one of those do you think? All right, let's play.
Amazon's also on Thursday, by the way.
And Amazon did $128 billion last quarter, or $128 billion. Which one do you think is going to beat expectations, even if slightly? Which one do you think is going to miss? And then which one do you think is going to be dramatically different than what analysts are expecting? So I'll start first. I think Facebook said 32 billion. I think they'll probably get to 32.2, 32.3. I think they'll be in that range, especially because holiday season, you get a lot of advertising. So I think Facebook will beat. I think Google will beat. I think the cloud will slow down a little bit because we saw Microsoft's cloud growth slow down a little bit, but I think Google will overall beat on revenue. And I think Amazon, I think they got it for like 135 or 138 billion. I think they'll probably stay at that level, and there won't be a hit or miss. Obviously, retail margins still suck, but the cloud will save them for now. I think Apple is going to be the most interesting thing. I think Apple will obviously beat slightly because it was the holiday season and people were buying stuff, but I'm very curious to know, what do they think is their next growth curve? Do they think the phones is just going to keep doing what it's been doing? Are they going to say anything about the headset? They're probably not. And I want to know how much services revenue increase, because services has been growing pretty well, especially their advertising sector, because they cut the head off of Facebook and Google's advertising machine with iOS 14. So Apple will be very interesting to see in terms of how they perform.
Can I just speak about your guidance for Apple? Do you not think that they are guiding for holiday sales? Like, do you think that the holiday is a reason to say that they're going to beat, or do you think that they know that Christmas is a thing?
Well, I think they would beat very slightly because they always beat. I don't think they're going to beat like crazy. I don't think they're going to put up 30 billion extra than they would. But when I think beat, I think all these companies, if they got it 32, they'll do 32.1, 32.2, if anything, 29.9. Like, nothing crazy. I don't see any of these numbers being different than what we think are really good. Like, not like a SoFi 44% EPS beat. I don't think we're getting that.
Yeah, so I and also because we're so small. If Apple did a 45% beat on anything, I mean, wow. But yeah, so I'll say I haven't been following these companies too closely, just because I've been trying to do everything in the fintech space. What I will say in a larger prediction, just while I'm here, I think Facebook is going to be a good company long term. I think there's way too much flack on that company. I think Amazon's going to be amazing. I think that their earnings are going to be good. I don't follow Apple closely enough, but they just dominate in everything. But I also haven't been looking into their guidance. I haven't held Apple in forever. So, but what I do want to speak about just really quickly, you're going to be finding people who are few and far between that are as bullish on AI as I am. Google is going to get destroyed. Now, what I will say is, this is just my prediction, is that their revenue is going to be fine this quarter. It's not going to touch them at all. But if they are guiding they are going to know that there's going to be margin compression here, and I'd look out for any guidance going forward, because they are going to know that search engine being 60% of their earnings is going to see margin compression, not because everyone's jumping over to ChatGPT, but because like maybe Google AI is perfect. Okay. Maybe it's amazing, but still that requires Google to give you the answer the first time that you search rather than the 6th time that you search. And that is going to be massive margin compression, even if they still own the space. Even if people don't go over to Bing, they're going to hurt themselves just to compete.
Well, why would they even release it then if they're going to ruin their business? Why wouldn't they just?
Because then people are going to go to Bing. If
because of Bing's AI is what you're saying.
Yeah, rock in a hard place, right? Either they keep market space by not evolving. Like Google's great. They have perfect ad tech, the best in the entire world, essentially. I mean, Facebook's pretty good as well, but I would say Google probably has the best ad tech in the world. And then, but you still need multiple searches to continue to service ads or serve ads. If they are going to give you your answer first time, and I don't know, I can't see.
Tannor, let me ask you a question real quick. Do you think that applies to YouTube or only Google, the search engine? Because YouTube, I feel like
YouTube was light last quarter, wasn't it?
No, I'm not even talking about the revenue. It was light, but I'm talking more about the sort of philosophical argument about search. Like YouTube, I don't think I would ask a Google AI to get me a video. I think I would want to see multiple thumbnails and titles always. Like,
but the thing is I think YouTube will actually grow due to AI. I think it'll allow a lot more people in the creator space, just because things like, scripting right now is a possibility. People can have access to that with ChatGPT 4 and future products that multiple companies are making. Facebook has their own AI. Google is coming out with their own AI. There's a ton of companies with really, really compelling offers that are going to allow for video editing, fake face profiles, everything along these lines. So this could be a lot more content coming out in the future. That's going to bode well for YouTube. I still think they're going to be the largest platform, right? I don't think that AI.
But do you think YouTube search get disrupted? Because YouTube's the second biggest search engine. Do you think that gets disrupted by some?
It could be the biggest. What I'm saying is Google still runs 60% of their business through Google search. YouTube is a small portion of their business, and you cannot buy the stock based on a 25% portion of their revenue, right? You need to focus on the main part. So this is even like Sofi, for example. You cannot focus on just the tech platform or the financial services. Lending is still the majority aspect of the company. You need to focus on that. So Google search, I think, is going to be a massive compression on their earnings, and they know it, and they're not going to lie about it. They're also probably going to guide for a much lower take rate. It's going to sweep through very quickly. I see, my parents and their friends talking about ChatGPT. You don't think whenever Bing starts coming out with that they're going to start sending links going, wow, you only need to ask once, rather than like you see it all the time. I don't even know how, like this term, I wouldn't even know how to ask Google this question. How do I answer this? ChatGPT will assume what you want, what you want to answer, and Google AI will also do that too. I'm not saying that they're immune to it, but there's going to be less searches.
Yeah, man. Okay,
Do you agree with that, Tevis? Do you agree with Tanner's analysis?
Slightly different take. I agree on the power of ChatGPT. I think there's a negative brand association with Bing, and also ChatGPT is this really, it's like a Ferrari engine on a freaking, whatever, like a like used car, it's amazing. Everything around it is complete crap because it's all like Microsoft products. Like there's no user experience at all. It's a horrible, there's a reason why the majority of people use Chrome. And from accuracy of search perspective, I think to the average person, that's less important than that overall user experience in Googling something. And so I just think that if ChatGPT was introduced in a net new Microsoft product as this new thing, a new search engine, then sure. But ChatGPT in Bing, I can just try to access ChatGPT on my own on Google Chrome. I just think that there will be a natural resistance for average people to go back to Bing because there was a reason that they left Bing in the first place, because it's just a horrible sort of user experience. I guess that's my only contrarian take. With regards to the earnings,
don't you think if people use Google search to get to ChatGPT, that's similarly to the effect that what's happening on Bing is that the number one search result is Google? You know what I mean? So like, even if people are doing one search to go to ChatGPT on Google as their primary search engine, that's still only one search when the reality of it is they need like 6. And that's the problem. It's really going to just get people the answers faster, and that is the compression. Even if Google AI, like some people in the chat saying ChatGPT isn't impressive, I'm not saying it is, right? Versus the competitors and everything like this, there is going to be lots of competition, but that does not bode well for Google's current results or current search engine that is very, very dumb, and they know it's dumb. I'm not saying they couldn't improve it, but they don't want to improve it because then it's going to lead to less search results. That's the problem.
Yeah, so I'll meet you halfway, and I'll say that the adoption is like ChatGPT is definitely a push in that direction. Hey, Riley, but the adoption is really dependent on the execution. And I just fundamentally, I guess, maybe this is just, some baggage.
Y'all talking about ChatGPT?
Yeah, maybe this is some baggage I need to work through, but I just fundamentally have a distrust of Microsoft products from a user experience perspective. So it's going to be based on the execution.
Well, let me ask you this question. The analysts, they're obviously going to ask about ChatGPT on the call. And how do you think, Tannor, how do you think Google answers this question? Let's say I'm an analyst and I'm pressing them on like, hey, eventually, if AI becomes as good as we think it is, which it seems pretty obvious, we don't need advertising around search results with user-generated content around SEO and blogs because we don't need that stuff. The AI knows it. How would Google monetize that at the level of scale that they're at? Do they charge $5 per month? Obviously, that's really bad for a lot of consumers that just, so how do you think we get around this?
It'll be free because the competition is so ripe that someone will offer it for free, and then they will own the space. That is capitalism, right? Like that's why prices don't always
monetize the same way that they're monetizing. Dude, it's the same exact way. It's just instead of it being reactive, it's now proactive in terms of you asking for something. Like you got to understand.
How are you going to show ads within that?
Yeah,
when you ask
a
question,
to be generating the ads, because that's going to be scary. Like where you
how
have an
is that
automated
scary, though?
an
It's the same
AI
experience, man.
chatbot that you like over
Dude,
time.
you guys gotta like get your head around this AI thing, man. Like it's not like
No. I'm just saying if
it's just a model that's based on data. Google has the most data in the world. They can just build a model, and instead of you asking it like, what is Sofi's? You can just ask it in question form, and it'll spit you the exact same thing with the ads, with everything that's embedded in the
I just
existing
don't want it
experience.
to be like. Also, try the new try this new like weight loss program right under.
No,
your
look. I
question.
think hold on. I think Riley has a point here because if I say best intermittent fasting tools, and then I ask AI, how do I properly do intermittent fasting? I mean, when I type that in the current Google, before I get the answer, I get like a link that is sponsored that leads you to some guy who's selling nutrition products. He wrote some blog post to generate traffic, all that stuff. If Google gives me the answer, his blog is worthless. So how do they even show the link of check out Mike's nutrition on intermittent fasting supplements? Like, how do you incorporate that into it? And also, doesn't that ruin the experience of actually getting
it'll be so the problem is that people look at ChatGPT and think it's going to be in this chat window like experience. It's going to be Google search the way it is, except it's just going to be much smarter. You're going to have the banner ads, you're going to have sponsored content that is written. There's going to be links to, different advertising. It's just the problem is that that's only going to be served one time. That's the only difference. I have no problems with the ability to actually advertise what Google AI is going to do. That will happen. It's just the amount of times that they need that to happen is either they're going to have to ask for a higher take rate, but then people are going to go elsewhere, right? If Google says, hey, we're going to increase the actual take rate on our advertising dollars, then people are going to go, okay, well, I'll advertise on Facebook instead. I'll advertise on Twitter instead. I'll advertise on these places that give me higher click-through rates.
And let me add just one more point onto that. People have a negative connotation or negative association with ads because they think of non-relevant ads. But if ads are curated and relevant to you, that's product discovery. Like you can find new things for yourself to buy. And so I think that that's also built into the model of saying, like, if I'm searching for something and I find a YouTube video of a content creator that I like, and he's promoting something that is relevant to what I'm searching for, then I'm going to be much more likely. And this is why you see all of these, like, influencer marketing is actually a thing these days because of that association. And so I think relevancy is a key important factor, and that's based on data.
Okay.
Who knows? Whenever we're already only seeing one version of this yeah, so like we're only seeing one version of this AI thing. There's going to be so many competitors. It's going to get so much smarter than we think, right? Like ChatGPT 4 is expected this year, potentially even the first half of this year. That's going to not only be 560 times stronger because it's going to have more nodes across the internet, 560 times more, but then also be a multimodal system, meaning you can throw in images, PDFs, videos, and then prompt it for what you want to do.
Wow.
Right?
Wow.
So,
oh my gosh.
so
This
that's
is
coming
insane.
this year. So, and then you have people like Meta who are building supercomputers with NVIDIA, 6,100 graphics cards and 6,000 of them, the strongest supercomputer in the world. And the head of AI is saying ChatGPT isn't impressive.
Yeah. Yeah.
And you think this will not affect Google's shit research search results? Like, it is terrible. Yeah. Okay. And they know it. It's built to be crap. So then you have to prompt it multiple times because that increases revenue. Imagine if Robinhood, if you could do all of your purchases on Robinhood in a single transaction versus multiple transactions. They want a ton of tiny transactions because that increases revenue. If someone comes out with a system where you could buy all your stocks, somehow make it all under one transaction, that's going to hurt Robinhood's business. And you're seeing that compression at Google. And yeah, I'm big AI though, so I'm a little too bullish. I'm the Riley of SoFi right now.
So you don't own Google, Tanner? You don't own Google?
No, I would not touch it at all.
Really?
Massive compression.
I agree. Well, so here's sort of my take. I think that there will be in 2023 and especially in 2024 a bifurcation in terms of the FANGs, in terms of, some of them are going to be really, really well as disruptors and some of them are going to start to fall off. I just think that Google is not going to let themselves become disrupted. They might still get disrupted, but they're going to do something in the process as a response to that. They're not just going to be like, oh, like, whatever, this is the current paradigm, because they already have all of that data. And so now it's just like, well, feed all that data into the model. And then all of a sudden you have your own competitor to ChatGPT or to, Facebook or Meta's alternative. And so I just think that they have the money, they have the resources, and they have the data. So I find it hard to believe that they're going to let themselves be disrupted so easily within a year of this new AI coming out. Like, AI is not a revolutionary thing. It's been on people's minds for the last decade. We're just now starting to see it materialize.
Yeah, but the problem is that, like I said, they could be still the dominant force in AI. That's going to hurt their earnings. Like, even if they are the number one, they're going to make less. It's like, even if TD Bank, back whenever they used to charge $10 or $15 per trade, even if they're still the biggest trading platform, if they're charging free commission trades, that's less. You know what I mean? So that is pretty much the revolution that we're going to see here. It's going to be less per user, regardless of user base.
Which is good for everybody, I think.
It is good for everybody, but that's capitalism. Like, even if they do a subscription model, which is what everyone in the chat is saying, or potentially saying, is that, okay, if Microsoft does it, then Google is going to do it for less money, and then Facebook's going to do it for less money, and then that is compression at its finest. It will be offered for free.
And did you hear about how Google's getting rid of cross website tracking cookies in 2024, like for everybody?
Wow, I didn't know that.
Yeah, that's a huge change.
That's gonna be crazy for advertisers.
It's gonna be like another apocalypse.
Yeah, you can't see what website, like, after you click a link, what website next you go to. Like, that's the entire advertisers.
What that means for the vast majority of people watching is that if I go to a website looking for a couch, that website can hold a cookie. And if I go to like another website, they could still like advertise the couch to me, or basically it tracks where you are and then it advertises you based on your search history. which is really, really profitable for a lot of companies advertising on Google. That's going to go away in January 1st, 2024.
Yeah, wasn't this part of the investigation on Google that was launched by the Department of Justice?
Yep. It's going to be very interesting to see what happens. We've got earnings this week. SoFi up 13% right now. We're going to end it here. 430 people. Thank you all for being here. Please, we've been live streaming for 2 hours, 34 minutes. Check out everyone in the description. Subscribe to them. You will get their updates. The content is well worth it. I watch these guys' channels. I enjoy their content. I'm happy building this SoFi Weekly podcast that turned into the Morning Open today with them. And
the Amit stamp of approval. I watch them. You should watch them too. Stamp.
I actually don't fucking watch them. I don't watch any of
this. Now I know you're lying.
Tannor, I have to. His retention on his videos keeps me watching his cut every 30 seconds because this guy in Africa is editing his own videos. They're crazy. So, dude's just throwing in cuts every second. And then Tevis, I just listen to him because he has a sexy voice, but I'm just staring at him the whole time.
Soothing voice.
And then Riley's deep voice is just so intense. But all right, that's it. Thank you guys, everybody. We'll see what happens with SoFi.
Tanner, real quick.
Yes.
I just want to say we should do eventually a Amit, Chris, potentially whoever wants it, whoever's involved in AI. We should do an AI-based podcast, not weekly, but just a one-off or something like this. I think it's upcoming and people want to hear about it.
That's a good idea, man. The state of AI. That's a great idea.
That's God.
And
Chris is pretty knowledgeable with this stuff too. I've been following him and I've been wanting to have a conversation with him about it, but yeah.
And since we're also like plugging stuff and talking about search and advertising, probably Amit and I are going to do a show on Pinterest coming soon, probably next week when Pinterest
Me and
reports.
Tevis are doing an unofficial podcast so far. We talked about Tesla, Pinterest. Maybe we'll talk about another random. But Tevis is a big Pinterest bull. Pinterest has 1 billion monthly active visits, 443 million monthly active users. Big search engine for images, might be undervalued by the market. We'll talk about that pretty soon. All right, that's it. Thank you, everybody. We'll see you on Friday.
Thanks, y'all.
Bye.